Hey everyone, this is my chapter review for chapter 16 from Trading Price Action Trends. I know it's been a long time since I posted. This one actually took me quite a while. It didn't take me 2 years, but it took me quite a while to do. It's about microchannels. I tried to make it a complete framework of how to engage with microchannels. I'm not sure if you'll get through it. It's 2 hours long, so it's a long one for sure, but I wanted to make it as complete as possible. It's not a complete system by any means, so there's a lot of experience and contextual factors that have to go into trading microchannels, but I tried to make it a framework where to give as many options as possible to engage with microchannels when the time is right to trade them. And again, this is mainly content from chapter 16 from Dr. Brooks's Trading Price Action Trends. It's also my experience with the material and my experience trading it, and also I've been working closely with Ali for the last few years from Quant Systems, and it's also a lot of material that I've learned from him over the years. So it's a combination and a culmination of my experience with the material. So if any of you see these topics in a different way or have a different interpretation than me, I'd definitely love to hear about it in the comments and discuss it. And because it's my interpretation of price action from the work of Dr. Brooks and Ali Afshari, I just want to make a quick announcement here that definitely use it as a supplement if you find it useful, but always best to go straight to the source. And that first source is Dr. Brooks's work. You can look at his 3 books, or you can purchase the Brooks Trading Course, which is his most recent body of work. You can purchase that from brookstradingcourse.com. I'll leave a link in the description. The second announcement that I want to make is that Ali Afshari from Quant Systems has created a new program called Trade With Me. And this is really exciting. It's something that traders have been asking for so long, and I'm really excited that Ali has finally decided to bring it to the public. If you're not familiar with Ali's work, he's a professional trader, he's a professional trading educator, and he's also the CEO of Quant Systems. He's worked closely with Dr. Brooks for many years. He's traded and taught alongside Dr. Brooks in front of hundreds of people at exclusive workshops, and now he's decided to finally bring that same experience to the public with a new 10-month program to give everyone the opportunity to watch him trade live and to understand in detail the fundamental principles of successful trading. So in this program, every month you're going to get 6 hours of educational content teaching you the first principles of market behavior. And at the end of each month, you're going to get the opportunity to watch Ali trade live using these first principles. So you'll get to see his screen as he's placing trades. You'll see where his entries are, you'll see where his targets are. You'll be able to watch him manage trades live. His main goal here is to educate serious traders on what's possible even with the minimum position size if you have the right tools and the right education. So if this is something that interests you, definitely check out the link in the description to learn more. Okay, so to start, I'm going to talk about just an overview of what I'm going to cover in this chapter review. I'm going to start off with defining terms. So one of the big things I noticed about the microchannel chapter is that Al talks about microchannels in a different way now than he used to in the books. So there's a little bit of a distinction between microchannels and tight channels and how he uses them now versus how he used them then. So I'm going to talk about that. I'm also going to talk about some terms that are used that confused me when I was first starting out in terms of like breakout succeeding or a failure failing. Those things take a little bit of time to get a sense of what they actually mean. So I'm going to talk about that in a way that helped me to understand it a little bit better. And then we're going to talk about how to trade microchannels in different environments. So what to do and what to look for when you're trading microchannels in different environments. And then finally, the details of how to actually engage with microchannels, how to fade them, how to look for high ones, look for second entries. So we're going to go over some things like this. So how to bet a breakout will fail, and talk about all the different options and exactly where to place the orders, how to engage with them, and go over all these options in detail. So to start defining terms, we're going to talk about the characteristics of a microchannel and define what a microchannel actually is. The reason I have this slide up is because I'm trying to discuss things that were confusing to me when I was going through the Dr. Brooks body of work. And I started with the books many years ago, and Al talked about microchannels more broadly in the books, whereas now he has a more strict definition of what a microchannel is. So if you're reading the books, he kind of uses microchannel to define microchannel and tight channel. So if you read the books, you'll see that he defines a microchannel as any move that has no pullbacks or very infrequent shallow pullbacks. So in the book, this move down has every high below the prior high. So it's a microchannel. It's also a microtrend. So every high is trending down. Then we have a break here, and then we have a move down with very small infrequent pullbacks, but there are pullbacks. We're breaking above the prior high on the way down. In the book, Al will still consider this a new microchannel on the way down. Whereas now, anytime there's a break above the high, the microchannel ends. and it becomes a tight channel. So I'm going to use that definition in this chapter review because that's how he uses it now, and it's more strict and it's more accurate in the way he talks about it now, and it's easier to identify different phases of the market cycle. So based on how Al defines it now, a microchannel is when there are trending bar lows in a bull move and trending bar highs in a bear move. So this is a bear move down. The highs are trending down. Every high is below or equal to the prior high. And then when we go one tick above the prior high, that microtrend is over. And same thing with the bull case. We have trending bar lows. Every low is above or equal to the prior low. And then as soon as we break below, that microchannel is over. A microchannel is usually a spike on the current time frame. So whereas a tight channel like this might be a spike on a higher time frame. If you look at this, for example, this is a really tight channel on the 5-minute chart. On the 30-minute chart, it's just a spike up. So tight channels with small pullbacks, they look like channels. They have a lot of overlap and they have opposite bars on the way up and small pullbacks. On a higher time frame, they're a spike. Whereas microchannels are typically spikes on the current time frame. So something like this, we have no breaks below the prior low here in 5 bars. That's a spike on this time frame. We have no break below the prior low on this move up. That's a spike on this time frame. So there are varying levels of strength. For example, this is also a microchannel on this time frame, but it has a lot more overlap. So this is a weaker microchannel and it doesn't look like a spike on this time frame, but typically when you have some strength in a microchannel, it's probably going to be a spike on this time frame. Whereas as soon as the market breaks below the prior low, so for example, here we have 5 bars up, as soon as we break below the prior low, this spike is complete. So we've broken the spike, the microchannel is over, and now the reason why I say that it's useful to look at the strict definition is because as soon as we break below the low, now there's a higher chance that we're going to enter a new phase of the market cycle. So now look at this microchannel up. This is also a microchannel, but it's coming later, and you can see the overlap and the pace. There's a higher overlap and a change of pace. So this is actually a channel phase after this spike break. So it makes more sense to define this as a microchannel, a break, and then another microchannel, but because it's the second channel, it has a different structure and quality. Whereas if you just define this whole thing as a microchannel because the pullbacks are shallow, it doesn't give you the same nuance as you would have if you broke it up into separate pieces or separate building blocks. And breakouts of microchannels tend to fail. So that's why microchannels are important, because when you have a lot of trending bars in one direction, the breakout is likely to fail against it. So tight channels have rare or small pullbacks, and you can usually draw a trend line to border the price action, and they're usually very close together. So the lines should be close together. The pullbacks are very shallow and they don't happen very often. And you can often see that the pace is different. So this is a spike, this is a tight channel, and you have breaks, you have more opposite bars. So the actual pace and the quality of the move is usually different in a tight channel. And it's usually a spike on a higher time frame, as I showed earlier. So it's a tight channel on the current time frame, but it's important to know that it's a spike on a higher time frame because the behavior of a spike usually leads to a second leg up. So even though this looks like it has overlap and it should pull back, once it does pull back, the expectation is more up, because when you see this on any time frame, like if you're trading the 5-minute chart and you saw this, you'd expect at least a second leg. And so on the 5-minute chart, when you see this, it might look a lot weaker than this, but you have to know on the higher time frame it's a spike. So even if it pulls back, the pullback's probably going to fail. So this whole pullback here is only 2 bars down, and it's probably going to break above the high and get a second leg up. So that has to be the expectation when you see a tight channel on the current time frame, is that it's probably a spike on a higher time frame, and the expectation should be more in that direction. And like I mentioned here, the breakout below the trend line is likely to fail when you have a tight channel because it's a spike on a higher time frame. This break below is likely to fail, become a trading range, and then continue in the direction of the trend. This is important because when we see a tight channel on the 5-minute chart and it's a micro channel on the 30-minute chart, it means that we know the dynamics of the micro channel are that the first breakout below the prior bar will fail. So in this case, we got 3 bars down. 3 bars down on the 30-minute chart are 18 bars down on the 5-minute chart. So if we're going to pull back for 1, 2, or 3 bars on the 30-minute chart, and we know that the pullback's going to fail, we know that we're going to pull back for either 6, 12, or 18 bars on the 5-minute chart after we break this tight channel, and that pullback's probably going to fail. So it gives us a sense of expectation of what to expect from the pullback and also expect direction. So we know that we're probably going to go down for 6 to 18 bars, and we're going to break below the prior low on the microchannel, but we're going to break below the trend line and probably the moving average on the 5-minute chart. So these kinds of tight channels are going to have deeper pullbacks, but they're still going to resolve to the upside. So a tight channel is simply a microchannel on a higher time frame, but just with more bars in it. So you have to adjust the expectation for it. We're not going to just fail at the low of the prior bar in a tight channel. When we have a tight channel that goes on for many bars, we're probably going to pull back for many bars, but then still resume to the upside. So there are 4 major options for breakouts of microchannels. So when we talk about a breakout of a microchannel, we're talking about a breakout against the microchannel. So the microchannel is up, and we're talking about a breakout against that direction. So the first option is the breakout is successful. So it's followed by more trading in the direction of the breakout. So here we have a bull microchannel. We break out below that low, and the breakout is successful. Now, successful is a subjective term depending on your goals as a trader. So if you're a scalper, a successful breakout of a microchannel might just lead to a small second leg. If you're a swing trader, a successful breakout might lead to a reversal of the trend and lead to all the way to a new low. So it's important to know your goals before taking the trade. And if you're betting on a successful breakout, to know what success means to you. Are you a scalper? Are you a swing trader? What's the expectation of the move you're looking for? So for the scalping situation, which I'm going to talk about here, a successful breakout is one that has at least a tradable second leg. So that's what that looks like. We have a bull microchannel. We break below it. It's strong enough that we get at least a small second leg that's tradable. So the second option here is that the breakout fails and leads to trend resumption. So the breakout against the microchannel fails. It doesn't go very far. It's not a very strong move down. And instead, trading continues in the direction of the microchannel. So we have a bull microchannel, a small bear breakout becomes a pullback, and we get resumption. So the third option here is that the failure fails and leads to a breakout pullback. So that's what we call a second entry sell. So that's the terminology that kind of took me a while to grasp when I was learning the concepts and trying to actually turn it into something practical. What does it mean for a failure to fail, and how do you think through that in like live trading? Maybe that's only me, and everyone else finds that pretty simple, but for me it actually was a little bit tough to wrap my head around. So what does it mean for a failure to fail? So when the breakout fails, it leads to resumption. If the failure fails, so the failed breakout leads to resumption. If the failure fails, that means the resumption fails. So that's what that means. When the failure fails, it means that the outcome of the first failure also fails. So the first failure leads to resumption. The resumption fails, leads to a breakout pullback sell. And finally, the fourth option is the breakout fails and evolves into a trading range. So breakout fails, but it might be deep enough that we don't get straight up and get resumption. Instead, we get more sideways price action. It becomes a trading range, and then we enter breakout mode, which usually continues in the direction of the trend. But once we get into breakout mode and we go sideways for more and more bars, the odds get closer to 50-50 of what we're going to do. But typically, it does go in the direction of the preceding trend. So one way that helped me, again, I don't know if anyone else struggled with this, but I definitely struggled with it starting out, is to think about the breakouts of microchannels as just reversal attempts. So just like we talk about 4 major options for breakouts, we can say 4 major options for reversals, for attempted reversals. So either the reversal is successful, so the breakout is successful, or the reversal is successful, reversing the microchannel. The reversal fails, and this reversal fails leads to resumption. The resumption fails and leads to a second reversal attempt. So that's a second entry sell. And finally, the reversal fails and evolves into a trading range. So you can look at it both ways, whichever way helps to actually make it more practical and actionable. Those are 2 ways to look at it. So why are microchannels important? Microchannels and the quality of the microchannels gives us information about the likelihood of a breakout succeeding or failing. So all these options we talked about, depending on the context, depending on where it's happening, depending on the market regime, all those things play a role in determining which of these options are most likely. And another factor is the quality of the microchannel, not just where it's happening, but also what the microchannel looks like. It can be strong, it can be weak, it can have a lot of overlap. So the quality of the microchannel itself can also play a large role in determining which of these are most likely. And we're going to talk about that a little bit later. So it gives us insight into whether we should trade the breakout or fade the breakout. So trading the breakout means you see a breakout against a microchannel. Should you trade in the direction of the breakout, or should you fade it, betting that the breakout will fail and that will get resumption? It also gives us insight into the potential path the breakout will take. So for example, if you're in a trading range and you want to trade against the microchannel, you want to bet the breakout will succeed, you may look at the microchannel quality and see that because it's strong, it may not take this path. You want to trade against the microchannel, but you don't want to take the first reversal because this move up is strong. So you might think the path will be, the breakout will succeed eventually, but the first one won't succeed. So this is the path that the reversal will take. It'll try to reverse once, get a resumption attempt, the resumption will fail, and then you'll take the second reversal. But sometimes, depending on the quality and the context, you might want to take the first reversal. So that's where context and quality come into play in determining what the likelihood of the breakout path will be. Will it work out right away like this, or will it need a higher high breakout pullback sell or a lower high breakout pullback sell? So those are all things to consider. Now we're going to talk about where they occur. So the environment that the microchannel happens in determines the probabilities of the microchannel. So a bull microchannel in a bull context, the goal is to fade the breakout. Now there are many ways to fade a breakout, and we're going to talk about that a little later in detail when we get to this slide here, how to bet that the breakout will fail. But the goal is, when we're in a bull microchannel in a bull context, you want to bet the breakout will fail. So you want to look for resumption, and there are many ways to do that, but the goal is to look for resumption. Now, what makes trading difficult is not to determine when we have a bull microchannel, but when we're in a bull context, because there's a bull context within a trading range. There's a bull context within a larger bear context. So that is actually where traders are made in reading the context. But this is the what to do for now. And the what to do is to fade the breakout when we're in a bull microchannel in a bull context, and then understanding when we're in a bull context, that comes from experience and deeper work into understanding the contextual factors. So, for example, here we have a trading range and a really strong breakout. The first breakout, so the first time the market goes below a prior low in a fresh breakout, it's probably going to fail. So what traders do is that they put a limit order here, and instead of selling below the prior bar, which would be betting on a successful breakout or a successful reversal, they're going to put a buy limit order and buy instead. So you're buying because you're betting that the breakout against this microchannel is going to fail. Now, you can see I have two arrows here. This is a microchannel up, and this is also a microchannel up. So there's no pullbacks here until here, and then after we get that first pullback, there are no more pullbacks on this rally either. But you can see the quality is much different. So this is 4 strong bull bars up. We're closing near the high, and then we get 4 bars in a tight channel here. But then this microchannel has opposite bars or pause bars after every bar. So this is consecutive bull control, a strong bull microchannel. And now this one is a little bit weaker because every breakout is followed by a pause bar. We got 2 in a row here, but then we got another pause. So the quality of this is much different. And when the quality is different, the response is going to be different. We're going to get a deeper pullback, especially when it's a later leg. So the factors that the context factors that affect probabilities and expectations are the leg count, the market cycle, and the internal structure. Now, these are all interconnected because usually if we're in the channel phase of the market cycle, the internal structure is going to be different. If we're later in legs, so if we're in leg 3, usually we're going to be at a later stage of the market cycle, and we're also going to have a different internal structure. So they're all interconnected, but they're all important to pay attention to individually as well. Because you can have a really strong spike in leg 3, and that shouldn't be traded the same way. So I call this, when I'm labeling it, I call it S2. So it's a strong spike in leg 2. So it's a strong microchannel break, and then a second microchannel. S2 typically has a deeper pullback, but still also typically has a channel that follows. So you can see strong spike, first pullback is bought, so that's an easy buy. Second pullback is also bought, but the pullback is deeper. So if you buy the prior low, this pullback is only a few ticks. This pullback is many points, and I think April was a high volatility time, so this is actually probably like maybe 10 points. But you still do get a channel out of it. You just have to expect a deeper pullback. So when you have an S2, so a strong spike, but it's in leg 2, the pullbacks are typically deeper, but you still do typically get trend resumption. So here we have S1, so first spike, strong spike, breaking out of a trading range, and the first pullback is quite small. Second spike, also very strong, should get a second leg of its own, but the pullback might be a little bit deeper. And as you can see, we got 2 bear bars in this case. The pullback's a little bit deeper. And just to be clear, when I'm talking about depth of pullback, I'm not necessarily talking about the actual distance traveled. I'm more so talking about the drawdown. If you take the entry below the last bar, the drawdown here is quite small versus here where it's a little bit larger, Same with this. If you buy the low of the prior bar, the drawdown is quite small. Whereas if you buy the low of this bar, the drawdown is much larger. So in terms of drawdown below the prior bar, it's usually larger. And also in terms of selling pressure. So there are usually more bear bars in the pullback after S2 than after S1. So same thing here. We have strong spike, pullback. That's an easy one. Second spike, also strong, but gets 2 bear bars, gets a deeper pullback, but still gets more trading in that direction for a small channel. Same thing here. Spike 1, spike 2. Spike 2 gets deeper pullback. You can call this a parabolic wedge, right? There's a lot of ways to name it. I'm looking at the quality of the microchannel, so I'm seeing this as very strong. It's breaking out of this. So it's the first time we have a breakout and follow through above the range. So I'm calling that S1, calling that S2, and expecting a deeper pullback here. Same thing here. Like this is a parabolic wedge, but this is the first time we get a strong breakout. So I'm not calling that S1, calling that S2, and expecting a deeper pullback and then a channel. And there's a bunch of examples of that. These are all like from this year, and some of these are from like the last 2 months. So you'll find those everywhere. Again, so we have strong breakout. This is the first pullback. Second strong spike, so S2. It's probably going to get a second leg down of its own. It's going to be more channel quality, but the pullback might be deeper. So you have to be prepared for that. So here, this is the slide I showed earlier that you can have microchannels, but they can have different internal structure. They can be different phases of the market cycle, and they can be at different leg dynamics. So leg 1 is different than leg 2, is different than leg 3. So when you have a spike up here and you get the first pullback, it's probably going to fail. That's an easier buy. And then the second leg, it's later in the market cycle, so it's a later phase. It's a channel phase. You can expect more overlap, and the internal structure is obviously different, and it's also a completed structure on its own. So these last 2 bars are also leg 3 of leg 2. So you can argue that this is the first leg, but Al likes to talk about the first spike as leg 1. So that's how I'll talk about it as well. So leg 1, pullback, leg 2, and leg 2 has 1, pullback 2, pullback 3. So you're buying leg 3 of leg 2. That fading that microchannel is lower probability. This whole thing is probably going to get a second leg of its own, but it's important to understand which phase of the market cycle the microchannel is happening in and what the quality of the microchannel is. So because this has a lot of overlap, and because it's a completed internal structure, and because it's leg 2 already, so it's already in the channel phase, it's probably not worth buying the low, and it's better to look for a deeper pullback before buying. And then there's other methods to buy later when it's coming after, when the microchannel is happening in a channel phase. There are other methods to buy, and we're going to talk about that a little bit later. So in this situation, market cycle and internal structure were important. In this situation, right here, let me just add an arrow here. So right here, there wasn't really a tradable scalp here. I mean, it's very small, but it's not the one that you typically expect from a microchannel. And here you wouldn't be able to convince yourself that the internal structure is complete. It looks just like five bars up. So the convincing factor here to let this go is leg count. So sometimes in this case, internal structure will give you a clue that, we're in a channel phase and we have a lot of overlap, and this is a completed internal structure. This one, not as clear about internal structure, but it is clear in terms of leg count as 1, 2, and 3. So you have to be more careful here fading this. And here as well, this is a microchannel. First fade is easy. This is also a microchannel up. So there's no low going below the prior low, but look at the market cycle. It's clearly a channel after this spike. So we're in a channel phase. We're also in leg 3. So 1, pullback 2, pullback 3, and the internal structure is also complete. You can look at it as leg 1, pullback, leg 2, pullback, leg 3, or you can look at it as leg 1, pullback, 2, pullback 3. So spike and channel in leg 3. So nested spike and channel. So there's so many factors to not fade this, not buy that low. So those are all the factors that have to be considered when you're fading microchannels. So those are all bull microchannels in bull context, but there's also nuance there. So it's not, you can take every microchannel in a bull context because you have to take those factors into account. So fade the breakout with bull microchannels in bull context, but be careful of the context and those contextual factors we talked about. The second environment to consider here is a bull microchannel in a bear context. So here we have a bull microchannel. It's happening in a trading range day. It's at the bottom of a trading range day, but this spike is strong enough that it should get a second leg. So you're looking at this microchannel as a flag. It's a bear flag. So you're expecting more down. Now, if you want to trade this, you want to bet on the microchannel break succeeding. So you want to bet that the breakout will succeed. It's just about when will it succeed. Will it succeed on the first try or the second try? And so often when a microchannel is strong and there isn't a clear internal structure completion, it's better to wait for a breakout pullback. So a bull microchannel in a bear context, if the microchannel is really strong, then you should wait for a higher high or a lower high breakout pullback. So we get the microchannel, we get the first breakout. Now you want to bet that the breakout will succeed, but it's about when it'll succeed. So you don't sell below that bar, you don't sell below the bull bar. You wait for an attempt up, so an attempted resumption. You wait for the resumption to fail, and then you trade the second one. So either the reversal or the reversal and follow through. So here are some more examples. So here we have a bear trend, bear spike. We get three bar bull microchannel. You wait for the break. You wait for the resumption and the resumption to fail. So the second breakout, you take that one instead. Same is true here. So we got a 4 bar bull microchannel. You bet that the breakout will succeed, but not this one. So after a strong microchannel, especially in a climax like this, we're expecting a test of the moving average or at least a second leg up from this. So the first breakout will likely fail. But you don't want to necessarily bet that the breakout will fail, because then you're going to have what I used to do a lot, which is trade counter trend. And yes, it works. Like, I'm only showing the ones that work because I'm trying to show breakout pullback sells, but there are a lot of them that don't work. And so if you just keep constantly buying, betting on a test of the moving average, you're going to lose a lot of trades when you're going counter trend. So for most traders, what Al advocates is, yes, this is a strong microchannel. Yes, it should get a second leg, and this breakout to the downside will probably fail, but don't worry about fading the breakout. Wait for the second leg to happen, and then trade the breakout pullback sell. So take the second entry sell, because you still want to trade in the direction of the market regime. So we're looking for a trend line break or a break below the microchannel, resumption to fail, and then we're trading in the direction of the trend. Here's another example. So we have a bear trend, we have a bull microchannel. It's also coming after a spike in channel, so we're probably going to get 2 legs up anyways. It is a reasonable trade, though, to buy below the strong bull bar here in the microchannel and look for a second leg up to the moving average. It is reasonable, but we're talking about bear flags and highest probability bear flags. The highest probability bear flag here is to wait for the breakout pullback sell. So first breakout fails, gets resumption, second breakout succeeds for trend resumption down. So that is the best case scenario when trading bull microchannels in bear trends. You want to wait for a breakout pullback sell, which happened here. So here are some bull options. We have a bull trend. It's also happening in the context of a trending trading range day. We had strong selling in the first hour, so we're probably not going to lead to a strong bull trend. So when you're buying this, you're buying a bull flag looking for a test of the high, not necessarily a continued bull trend. But either way, this is a microchannel down. So you think that the breakout will succeed in the direction of that trend, but the first breakout may not succeed right away. So you wait for the first breakout to fail, and then the resumption to happen, the resumption to fail, and then the second breakout to succeed. So you can call it the second breakout, you can call it the second reversal. Second reversal makes more sense in these contexts. So wait for the first reversal, second reversal, and then buy that. Same thing here, strong microchannel against a trend. Also a possible trading range day because of how we started. But the first breakout fails. In this case, we got a lower low. So here, if you bought that first reversal, you would have been okay with a stop below. But sometimes you don't get that. Sometimes you get below, it stops you out, and then forms a second reversal. And so in this case, you wait for the first breakout to fail, take the second breakout, or see it as wait for the first reversal to fail, take the second reversal. Both ways of looking at that make sense. Whichever one helps you actually make it actionable and to have clarity when you're taking the trade is what's most important. And the next option is to just take the breakout on the first try. So betting that the first breakout will succeed, it's more aggressive, but there are situations where that's more likely. And we're going to talk about that when we go through the 4 major options of breakouts and talk about when the breakout is most likely to be successful right away. And the third environment is a bull microchannel in a trading range context. And if we're in a trading range, you have to determine, are we low in the range or are we high in the range? Because it's going to lead to different outcomes. So if we're low in a trading range, you want to fade the breakout. So you want to buy. So we have a bear spike, and we're in a bull channel now. And yes, the bull channel is drawn after the fact, but because we're in a bull regime, the moving average is pointed upwards. We have a strong move up here. We're probably going to get, after a wedge or 2 legs down, we're probably going to get a second leg up from this. So when we get 3 bull bars up, that's a good buy to fade that, betting that we're forming some kind of bull channel. So in this kind of situation, you want to fade the microchannel, betting that the breakout below the microchannel will fail, and that will get more up. And another situation where we're low in a trading range is when we're low in a developing trading range. So here we have a spike and channel. You can see that this 3 bar bull microchannel happened after the spike phase. This 5 barbell microchannel happened after the channel phase. So we had 3 pushes down, and then we got a 5 barbell microchannel. That is a much better fade to bet that the breakout below will fail. So depending on where we are, this is low in a developing trading range. So it's much higher probability to fade this microchannel than to fade this microchannel. So if you have a bull microchannel, but we're high in a trading range, the expectations are different. So if you're high in a trading range and you have a bull microchannel, you know that the bull microchannel means that there's strength. And so what Al recommends for traders, especially if they're trading with stop entries, is to look for a higher high or lower high breakout pullback sell. So for example, here we're in a trading range. We have a strong microchannel. Some advanced limit order traders can bet that we're going to get at least a test up. So if Al is advocating for a higher high or lower high breakout pullback sell, in most cases, we're probably going to get some kind of higher high or lower high. So a lot of advanced limit order traders will take buys below these bars, betting that the initial breakout will fail, looking for a scalp. But it's also more dangerous and takes a lot more experience. So for most traders, what Al advocates is you wait for the first break to fail initially, wait for the resumption to fail, take the second entry at the high. Now we're talking about more details about this later, but this is just in this context, you're looking for a lower high or higher high breakout pullback sell. So here's a situation where we're not in a trading range at this point, but we're in a trading range environment. So we have an upper range, we have a 7 bar bear microchannel for a breakout to the downside, and probably going to form a lower range. So we make an assumption based on day structure because we have a bull regime, upper range, and a breakout, probably not going to become a bear trend. So we want to look to buy in the possible developing lower range, but we don't want to buy the first reversal after a 7 bar bear microchannel. So this is where Al recommends wait for the first break, better if it's strong with bull bars, wait for resumption to fail, and that failure comes with a good signal bar. Now here we have a small inside bar. It's still a bull bar and it's still reasonable, but if you don't feel confident taking that trade after 3 bear bars, which is okay to skip, you wait for a reversal and follow through. So once you get the follow through bar, now you can start buying pretty comfortably. So another example of when you're in trading range environments, you want to wait for breakout pullback entries. So strong microchannel, you want to buy, but you don't want to buy the first breakout. You want to wait for the second breakout or the second reversal. The second option, when we're high in a trading range and we have a bull microchannel, is to look to buy at the trap price. The reason for this is that bull microchannels in trading ranges, they actually put buyers at the bottom extreme. So here, for example, we have a bull microchannel, but it's a minor reversal. So yes, if you bought this low and this low, you would have made money for a scalp if you did it properly. But it was just a small, you either get out break even or with a small profit if you're trading this in the right way. So if you're buying below strong bull bars and looking for a small test up, not for a resumption of the trend. If you're doing that, you can make money. But what's really happening here is that all this strength is putting buyers down here in the bottom third. So traders who are looking for limit order buys in a trading range are actually looking to buy down here and not necessarily up here, even though advanced traders can do that. Same is true here, right? So we have a strong bear microchannel, but we're always in long in a strong bull regime. The sellers are actually up here. You have a strong bull microchannel in a trading range. The buyers are actually down here. So you can see that bulls are not buying, they're not necessarily buying up here, even though you can see that if they did buy that low and they waited for reversal follow through and they got out break even there, and bears who sold this high, if they waited for reversal follow through, they're able to get out break even here. So it's possible to do that if you're really agile with it. But the market dynamics of it is that strong bull microchannels in trading ranges that end up high in a trading range, they put buyers down here. And so you're looking for trap prices. Where are the bears trapped? And looking to buy there. And the same is true here. Where were the bulls trapped? Right below that low. And you can see sellers sold there for a scalp. So trading ranges have a different dynamic where strong bull moves put buyers in the lower third. Strong bear moves put sellers in the upper third. And the same is true here. So we had a strong bull microchannel. Yes, you got a small scalp up to the high close, but you can see when we pulled back to that bear trap. So it put buyers in the bottom third, and you can see we bounced there twice. So that's a little bit more advanced, but that is an option when trading with limit orders in trading ranges to make sure you don't buy too high and you're looking for areas of support where the other side is trapped. So now we're going to talk about the details of the 4 major options for breakouts. And we're going to start with breakouts that are successful on the first try. So what are the contextual factors and what situations make it more likely that a breakout is going to succeed on the first try? And that is when there is a completed internal structure. So there are strong microchannels and there are weaker microchannels. And weaker microchannels tend to have overlap and tend to have opposite bars. So we get a bull bar, a bear bar, a bull bar, a bear bar, and then a bull bar, another bull breakout, and a bear bar. So here on a lower time frame, this is actually quite a broad bull channel because the pullbacks are quite deep and you're getting alternating bars. So in this case, if you're betting that the microchannel breakout's going to succeed, you have a higher likelihood than if this is if it's just 6 straight bull bars, because on a lower time frame, this is a completed structure. So now selling below that bear bar is actually more reasonable. So if you're aggressive and you see this big bear spike, we're probably going to get a second leg down from it. It makes more sense to sell below that bear bar. Now, it's still higher probability to wait for the actual bear breakout and then sell a pullback. But if you want to take the sell for a swing, this is an area where you can bet that the breakout will succeed on the first breakout. Here's another situation. So we have a bear microchannel, then we have a bull bar, pause with more selling pressure, another bull bar. So internal structure complete. This also has a higher chance of succeeding as a microchannel breakout. This is a microchannel, but it's very weak. It's happening in a situation where we should get a second leg down from this. So it's more reasonable to bet that the breakout will succeed on the first breakout and not wait for a higher high or lower high pullback. So first breakouts are more successful when the internal structure is complete, like we talked about here and here. So we have 3 internal pushes up that are very clear. The second situation where first breakouts are more successful is when the larger structure is complete. So when we have a leg 3 in a trend or leg 2 in a trading range, you often won't need a second entry, buy or sell. Because of the context, we're late in a trend in leg 3 or leg 2 in a trading range. A lot of those can just happen right away on the first try. So an example of this where the larger structure is complete is a situation like this, where we have a microchannel down here, first break. This is just a spike. You can say it's a 3-bar microchannel, but it's really just a spike down for leg 2. And then leg 3 is a 5-bar bear microchannel. But this is a completed structure. It's 3 legs down, and the quality of the microchannel is overlap and with pauses in between. So the internal structure is not very strong, so it's a weak microchannel. It's happening in leg 3. So the first break of this one is much more likely to succeed than this one and this one. So when you're in leg 3, you have a weak microchannel, you have pauses, so a weak internal structure or completed internal structure, you're more likely to get a strong breakout to succeed and get 2 legs up. A good example of leg 2 in a trading range when a breakout is most likely to succeed is a bear flag, for example. So a bear flag is a minor reversal, and minor reversals are trading ranges. So when you get the first leg up, the expectation is that the breakout below the first leg is probably going to fail. So it's a microchannel right here, but it's the first leg after a spiking channel down, so we expect the first breakout to fail. Now this move up is also a microchannel of its own. So it's a 4-bar bull microchannel, but it's happening in leg 2 in a bear flag. So it's leg 2 in a trading range at the moving average, and the signal bar is very good. So that's a pretty straightforward sell, betting that this breakout below this microchannel is going to succeed right away, because it's technically the second failure or the second breakout to the downside. But this is a microchannel on its own. So it's the first breakout of this microchannel, but this microchannel here is happening in leg 2. So it's acting as the second reversal, even though it's the first reversal of this microchannel. So it's important to look for the placement of the microchannel and where it lands in a trading range or in a bear flag or even in a trend, and base the breakout probabilities on that. So here's another example. We have a bear trend. We have a 4-bar bull microchannel here. We expect the first breakout below to fail. Now we're looking for a resumption and a second failure, but the resumption happens with a microchannel of its own. It's another 4-bar bull microchannel. But this one is much more likely to succeed on the first try because it's technically the second try, because it's the second leg up. So those things are important to keep in mind, that you don't have to stay away from every 4-bar bull microchannel and think of it as a super strong move on its own, because depending on the context it happens in and depending on what number leg it is, it's going to have different probabilities of the breakout succeeding. So 2 legs up in a bear trend, even if the second leg up is a microchannel, it'll have a higher probability of succeeding, especially when you get a breakout bar like that. Third is in trading ranges. So if we're just in a trading range, there's a greater risk of the first attempt working. So we have a bear microchannel here, we have a bull signal bar, it works to the top of the range. We have a bull microchannel here and a bear signal bar, and that works to the bottom third of the range. The important thing here is not to take these first reversals necessarily, but to understand that fading these microchannels is not as safe as it may seem. There's a lot of strength, but because of the context, the first reversal can succeed more often in these contexts, and so to not fade the microchannel with limit orders and to wait to either buy in the bottom third or sell in the upper third. The fourth situation where we're more likely to have the first breakout succeed is when we're with regime. So if we have a strong bear spike early in the market cycle, strong bear spike leading to a bear flag, or strong bull spike leading to a bull flag. So here we have a bear spike, a strong bear spike, opening range breakdown. So early in the market cycle, fresh breakout, 3-bar bull microchannel. So this is a situation where you don't want to fade the low of the microchannel, betting that we're going to get to the moving average. It's possible to do that. And in those situations I showed earlier, all those examples ended up getting up to the moving average or getting a second leg up to a new high, or at least a tradable second leg. But in strong bear spikes or strong bear markets, that bull microchannel can fail immediately. So it's important to realize that although it can happen and does happen often, and it often does lead to an important price. So here the microchannel failed, and you can see that the actual best way to trade this was to wait for the breakout and sell the retest of that bull bar, because we're probably going to test there and find sellers because that's a trap. That's a lot more advanced and not really in the context of Al's content in the chapter in the book. That's a lot of stuff that Ali talks about. But it's important to realize that these first breakouts can succeed a lot more often when it's following a spike, and so to be careful fading these. And so often you will see what I was showing earlier in the sense of getting those second legs. So here we have a 3-bar bull microchannel. We got a second leg. So it's better to wait and sell the second entry sells. And even here, strong spike, 3-bar bull microchannel. It didn't trigger below the bear bar, but we didn't go above the high. So we got the first breakout, and then we got a breakout pullback sell. That's a highest probability sell, to wait for the breakout pullback sell. But sometimes they do succeed right away. So in situations like this, if you want to sell that low and you have your stop above here, that's perfectly okay, because there's a higher likelihood that it's going to succeed because it's a strong bear spike. And also you're ready for a lower high test or a higher high test to either sell more, or you have your stop in the right place. So it doesn't really matter. So those are things to consider, that these first breakouts can work more often in these kind of environments. And the same is true here, right? So we have a strong spike, second spike. So it might get a deeper pullback, as we talked about. S2 often gets a deeper pullback. And here, if you faded this, you would have made money on a scalp, but it's a very quick trade. Like, you may not get this. So it's much more risky. But then here we have a 3-bar bull microchannel. That's a much higher probability fade because it's happening after 3 legs down. So the market cycle is different. We're in a different environment. Based on day structure, we're also probably in a trending trading range day. So depending on where the microchannel is taking place, the probability increases. So after the third push and these 3 bars up, we're probably in a developing trading range. So now you're technically buying at the low of a trading range. Whereas for this 3-bar bull microchannel, you're actually just buying low in a bear flag. And a bear flag is going to lead to more down. So that's a lower probability trade. Whereas here you're buying low in a trading range, and that's more likely to get a second leg up. I want to show some examples of the scenario where we get a bull microchannel against a bear trend or a bear spike, and the first breakout succeeds right away. Or the opposite case, where we have a bull trend, a bear microchannel against a bull trend, and then the first breakout to the upside succeeds right away. Because a lot of the situations I'm showing, if you buy this and buy more lower, you'll make money on a scalp and looking for a second leg up. And that is true. If you have a really good system for trading microchannels, you can make that work. And if you have a good sense of how to manage a trade, you can make that work. But I just want to kind of balance it a little bit and show, I've only showed these ones because I've been talking a lot about second entries, but I want to show the situations that fail as well, so that just get the full picture. So a lot of times you will get this when you get a strong move up. We're far from the moving average. You will get a pullback and a second leg, so you can fade the first breakout to the downside. And here as well. So we get a 3-bar bull microchannel against a strong bear spike. If you buy there and buy more lower, you'll get a small second leg sideways to up. So that was a reasonable scalp to take. But then there are situations like this, which I've showed, where the breakout just works right away. So here on the right side as well, we have a bull flag, 3 bear bars in a 4-bar bear microchannel. And if you sell that high and sell more high, you make money on a scalp, but you have to be really quick. And the point is that a lot of these will just succeed right away. You don't really get a clear second entry. So you just get a strong bull bar, and then we just start to race up. So you have to be really, really careful and not expect an equivalent symmetrical second leg down every time you see a microchannel. So you can see that in a lot of these situations in strong trends, the first breakout does succeed right away. Now, there are ways that you could have crafted it or managed it in a way to get out break even or with a small scalp. But the point is that a lot of these first breakouts do work. So in this situation, it's 4-bar bull microchannel, works right away. Here, it's a 5-bar microchannel, the bear breakout works right away. It does pull back first. And so here it does pull back first. But after the microchannel, there's no real resumption and then failure. It's just bull bar and then continues up. So a lot of times when you're betting on more in the direction of the initial trend, you're not going to get a perfect second entry. Sometimes the first breakout works depending on the context. So it's important to be aware of that. And here again, 3-bar bull microchannel against the bear trend failed on the first breakout. So we did get what the expectation is, which is usually after 3 bull bars, we'll get a breakout pullback sell, or we'll get 2 failures by the bulls and then a bear breakout. So we need some kind of hesitation here after 3 bull bars, but sometimes we don't get that. As you can see right here, we had 3 bear bars in a bull trend and we just race up. So there are risks, and I just wanted to balance that to show that not every bull microchannel or bear microchannel is going to get a second leg that's tradable. So it has to be in the right contexts. Even here, strong microchannel to the upside, and then bear microchannel, it just works on the first breakout. Now, one important thing I want to mention here is that because the microchannel price is important, so if you're not comfortable buying the first breakout, one thing that you can do, which is something that Ali talks about a lot, is that you can wait for the breakout and then an extension below the breakout, like here. So you see the microchannel to the moving average, it's 5 bars up, 4 bull bars. You don't feel comfortable selling the first breakout. You think it might get another lower high to the moving average, which is reasonable. But then you see another bear bar and a bad buy signal, and it extends a lot lower. So now this is a strong bear move, and bulls who bought that low are trapped. So if you don't feel comfortable taking the first buy as a limit order option, you can wait for the retest of that trap price. And you'll see that happens quite often. Bear microchannel here, you see the bull breakout, you can take that with the right stop. Or if you don't feel comfortable taking that because it's the first breakout after 3 bars down, you wait for more buying in that direction and look for a test of the trap there. And then here as well, we get another strong breakout, pull back in a 4-bar bear microchannel. Not a good buy signal here. So there's no reason to buy. Then you get a strong breakout and follow through. You don't want to buy the third leg up too high. And so you wait for that trap price to get tested and then buy with a limit order. So in a lot of these situations, if you don't want to buy the first breakout, the trap price entry is actually a really good option as a limit order trade. That's a lot of Ali's work that I would really highly recommend that you check out the Quant Systems website and look at the PTM recordings, because he talks about this a lot, that if you don't feel comfortable buying the first breakout, there are a lot of other ways to engage with it. But this is just to show that the first breakout does work a lot of the time. And so you have to be really careful fading counter trend. The fifth situation where first breakouts are more likely to be successful are in situations of consecutive climaxes. So when you get consecutive climaxes in a certain direction, like here we have a spike, pause, spike, second spike, so S2, and then S3, third spike. This is a strong spike. So the internal structure is not really clear that it's weak. It's actually strong, but it's happening in leg 3, and it's 3 climaxes in a row. So you're expecting at least a deep pullback. And in these cases, we often get 2 legs up to the moving average or 2 legs up to the high of the last sell climax. So in this case, we have a 1, 2, 3, 4, 5, 6 bar bear market channel, but this breakout is much more likely to succeed than this one and this one. This one didn't even trigger. So this one, bears are still completely in control. This one triggered but failed right away. This one's more likely to succeed. It's leg 3 and consecutive climaxes. So understanding where we are in the market cycle, where we are in market context, and the approach to that microchannel all plays a role on if that first breakout is going to succeed. And these situations where you're betting on the breakout to succeed on the first try, if you're buying, it's best to have a bull signal bar. And if you're selling, it's best to have a bear signal bar. So you don't necessarily want to buy above any bear bar if we're late in the trend. You want to wait for a good signal bar. So in this case, buying above a bull bar is ideal. Now we're going to talk about the second option for breakouts, which is when the breakout against the microchannel fails and leads to trend resumption. And we're going to talk about a lot of different ways that we can capitalize on betting that the breakout will fail. So I think one thing that's important to know is that when we are in a microchannel, the microchannel is formed because there were enough traders on the prior bar who thought we were going higher. So when we have a 2-bar breakout, the third bar is created because most people thought that the first 2 bars would lead to a third. And the fourth bar happens because people thought the first 3 bars would lead to a fourth. So just waiting for the microchannel to end is usually leaving a lot on the table. So there are many situations where we have a lot of bars in a row, and if you're just waiting for the break of the microchannel to take the trade, you might be too late depending on the internal structure, but you're also missing a lot of trades that are very reasonable. And so the concept of betting that the breakout will fail isn't necessarily only taking the trade when the breakout fails. So when there is a breakout and then it fails, but it's also about understanding that when the likelihood of the breakout failing is high, you can use that as protection to be more aggressive. And that's something that Al talks about a lot in the room. And he used to a couple of years ago, where he would talk about that bulls are okay buying high in certain situations because they know that if we fall below the prior bar, there's going to be buyers there. So when bulls think that we could easily accelerate up, a lot of bulls will just buy early and aggressively and then scale in below a bar. So that is a situation where you don't only have to wait for the breakout to fail. You can also know that the breakout will probably fail and then use some of these options if you want to be more aggressive. So this list here goes from high urgency to low urgency. So high urgency would be buying the close of the bar because we're in a high momentum environment. We're in a fresh market cycle, so we're breaking out of a trading range and we're breaking out in a strong way. So we're getting big bars, we're getting low overlap. The market environment is showing breakout and follow through, probably going to get more up. So when the momentum and the market context is showing signs of aggressive buying, that might be a time when traders should be aggressive too and start buying closes. And that goes all the way down to low urgency environments where we might be later in a leg, we might be late in the market cycle in a channel phase, we may be in a trading range environment where we want to be more patient, buy a little bit lower. So we're going to go through all these in detail and start with buying the close. So there are certain situations that are conducive to buying the close. And that is when we have a good sense that even if we pulled back below the prior bar, there are probably buyers there. So here, buying this close is reasonable. It's a transition above the moving average, a strong breakout and follow through. And in this case, if you waited for more information on the third bar, you would have gotten a better buy below. So you could actually trade the breakout below this bar and bet that it will fail. So you put a buy limit order at the low bar 3, betting that the traders who bet on the breakout will lose money. We're probably going to go above that high. So you'd have more information if you waited. But there's also a reason to not wait, because you know that if that does happen, there probably will be buyers below. And what if you don't get a pause bar? What if you don't get a breakout below? Then traders who are aggressive, in this case, they may regret it and think they could have waited. But look at this situation, breakout and follow through. In this situation, you couldn't have waited. So traders who bought the close aggressively ended up making money, but traders who waited to buy below a bar ended up missing the trade. So that's why buying the close, even though in this situation you could argue that it was better to wait, some situations it's not. And so if you're willing to scale in, it makes sense to buy the close sometimes. So here as well, we have channeling behavior, and then suddenly we get a strong breakout and follow through. A lot of traders just buy that close, and you can see that's what traders did because we did not pull back at all, maybe a couple ticks. So in high momentum environments, especially if you're willing to scale in below the bar, traders knowing that there are probably buyers below this bar are very comfortable buying this close because they can buy more lower and they'll still be okay. And then here as well. So we had a transition below the moving average, a bear flag, and then we got 2 strong breakout bars that broke below the entire trading range. So fresh breakout, really strong breakout, very reasonable to sell the close here, especially if you're willing to sell more higher. So in this case, you would have made a quick scalp if you're scalping. You also would have made a swing if you're swing trading. And if you were just waiting to trade above the prior bar to fade the microchannel break, that didn't happen until here. And you did make money on that. So if you did sell above that bar, you would have made money. But there were 5 or 6 trades on the way down here. So for a trader who's versatile and who's able to read the context and make those decisions on the fly, they can get a lot of trades in one microchannel. Whereas if you're just waiting for the break alone, you might get just one trade, and sometimes it'll be too late to take it if the internal structure is complete. So here you could have sold a close, you could have sold the bad buy signal, you could sell the low 1 signal bar, you can sell the low 1 breakout, you can sell the response to the low 1 breakout. So there's a lot of ways to trade this microchannel instead of just waiting for the failed breakout above. And that's why I wanted to talk about this list, because there are a lot of ways to engage with this. So that was buying the close and selling the close in bear environments. That's the most aggressive option. Second down the list is buying in the buy zone, betting that the first pullback will fail. So you're not necessarily betting that the first breakout will fail, you're betting that the first pullback will fail. And this is more common when we're in bar 3 or bar 4 of a microchannel. I'm going to show a lot of examples of this, that typically when we get 3 or 4 bars in to a microchannel, especially when the bars are strong, the odds are that we're going to start to pull back more. So you're going to bet on the pullback failing, or at least the counter trend move to fail and become a pullback so that we get resumption of the trend. So the buy zone is something that Ali talks about a lot. And the buy zone, how I'm defining it here is it's the bottom half of the bar, but not including the actual low tick. So I have buy in the buy zone, which is buy in the bottom half. And then I also have a separate option for buy the low of the prior bar, which is the actual technical breakout. The reason I have them as separate options is because when we go below the low of the prior bar, we're breaking the spike, we're breaking the microchannel, and it's a new major event. Whereas we're going to pull back a lot into the buy zone during a microchannel, and that can happen multiple times. But as soon as we break below the low of the prior bar, that is a new event, and the spike has been broken. So I like to separate those into two separate options, depending on how aggressive we want to be and the market environment. So the buy zone is the bottom half of the bar, but not including the low tick. So often when we get 3 bars in a row, a lot of traders will stop buying closes because the chance of a pullback becomes higher. So we often pull back into the buy zone of the third bar when the first 3 bars are strong. So we have 3 strong bull bars, probably going to pull back into the buy zone, more likely than not. Now, you don't have to wait. You can also buy the close and then buy more lower, but a lot of traders do wait for a pullback when we get 3 bars in because the chances are actually higher of a pullback than continuation. So here's another example. So we have strong breakout and follow through. A lot of traders buy that close, and like Al talks about in the room, he often buys a close and scalps, and buys a close and then scalps and waits for more information. So he can treat every bar as its own event and see how it's behaving. So you might buy the close of bar 2, but then you see bar 3 in that strong breakout. And instead of buying the close there, you might buy a pullback into the buy zone, because after 3 strong bars, we are probably going to pull back into the buy zone. That becomes more likely. Here's another situation. So 3 strong bars, and we pull back into the buy zone. So once you see 3 strong bars in a strong spike, it's a microchannel, but it's a very strong microchannel. It's a strong spike, low overlap, big bodies. Those are situations where you might stop buying the close and look to buy in the buy zone. Now, sometimes if you're doing that, you might see 3 big bear bars and look to sell in the sell zone, which is the upper half of that third bar, and you won't get filled. And that happens if you're trying to be patient and try to get the best price based on the likelihood of a pullback. You may miss your entry. And that's where we get into number 3, which is a contingency entry. So buying the reversal bar or buying a pause, or in this bear case, selling a reversal bar or selling a pause. So in situations like this, when you're waiting for the best price, you know that we're probably going to pull back after 3 strong bear bars. You're waiting for the best price. You get the luxury of getting more information. So either we pull back and you get the price that you want, or you get some information that we actually paused. We created a bad buy signal bar. We created a pause bar. That is a sell to close bar. So that becomes a contingency entry that you wait for your best price. You don't get it. You see a doji or a pause bar, and that's a good sell to close bar. But knowing that even if we go above the prior bar, so if we go above the doji, we go above the strong bear bar, we're probably going to find sellers. So you can sell the close and sell more higher, or just sell the close. Now, it's important to know that once you get a doji late in a microchannel, in this case, it's a 10-bar microchannel. This is a new breakout because it's obviously a change of behavior, but it really is a multi-bar microchannel. So when you get dojis late in a bear breakout or late in a microchannel, it often leads to a tight trading range within 1 to 3 bars. So that's something to keep in mind when you're selling that doji. So no fill on the sell zone, see the doji or pause bar or bad buy signal bar, and just sell that close. So here's another example. We have 3 strong bull bars, and a lot of bulls will wait for a pullback. Now, here, obviously, if you waited for the pullback, you would have missed that trade. And bulls who bought the 3rd strong close, they would have made money. So by waiting for your price, you're going to miss some trades, and that's just part of it. But when you see the 3rd bar, you wait for the buy zone, there's no fill. You see the 4th bar, that increases the chances that we're going to pull back to the buy zone. So you wait for that, but there's still no fill. But now you get a contingency entry. So we didn't pull back, but we got a doji. So that's a pause bar. It's a bad sell. That's buy the close. So you're waiting, but you're not waiting and missing everything. You're just working down this list. So if you bought the 2nd close, you made money. And then the 3rd close, you don't want to buy. So you wait for the buy zone. But the buy zone doesn't fill twice. So then you move down the list and we go for buying a reversal bar or pause bar. So you're not missing the entire thing. You're just waiting for your price and trading on your terms. And so by doing that, you might miss 2 trades here, but you get this 3rd one, and 4 strong bars and then a bad sell. That's a really good buy. So in this situation, you may see 3 bear bars and not sell. Even though this looks like a change of pace, it's not uniform. This breakout bar is actually bigger than those 2. So it looks like a new move entirely. But let's say you treat it as bar 3 in the microchannel in the strong bear breakout. You look to sell the sell zone and there's no fill. And then here you look to sell the sell zone again. You might get filled on this bar. Or if you don't get filled, you sell the close of the doji. Now, if you sell the close of the doji, this time we didn't get continuation immediately. We got a pullback, but you know that the first breakout is probably going to fail. So you sell the close of the doji, you sell the close of the doji, you sell more above the last bear bar, and you're more than fine. So the point of this is that all of these trades are very high probability trades. So selling the close of the doji is high probability. Selling above the bear bar is high probability. Taking two individually good trades and you're scaling in at the high of this bar, knowing that you took two good trades, they're both high probability. And if you don't make money on this one, you're going to make money on this one. So same situation here. We get 3 strong bear bars. So you look to sell in the sell zone. If you don't get that sell, you can sell the close of the doji. Here we got maybe a scalp down, but if you didn't take profits there are sellers above the high of that bar, and you can see eventually we reverse down. So there are many ways to engage with this. You can also argue that after 3 bars down and the doji, you don't want to take that sell. You actually just want to wait for the pullback. And that's an option too. They're both reasonable entries, to sell the close of the doji and to sell above the prior bar, betting that the breakout will fail. So another example here. So 3 bars down, looking to sell in the sell zone, no fill, and then a doji pause bar, sell the close. Another example here. So 3 bars up. Here we did get filled in the buy zone if we bought. So if you're waiting for to trade the low of the prior bar and you didn't get filled, that's the contingency entry. So here we got filled in the buy zone. If we didn't get filled in the buy zone, you just buy the close of that pause bar for one more bar up. And again, this is a very common dynamic that Al talks about all the time. So you get a doji, especially if you're in a leg 2, you get a doji late in a microchannel or late in a breakout, it's going to enter a tight trading range soon. So it's not, I know it may seem like bias that we're buying this close looking for 1 bar because it only went up 1 bar. That's not the case. It's after a doji late in a breakout, especially later legs, we often do only get 1 to 3 bars before a trading range. So even here, right, we have a strong 3 bar breakout. We got filled in the buy zone. If you don't get filled in the buy zone, you buy the close of the doji, and then we get 1 more bar. So 1 more strong breakout and then sideways, and then we get a larger trading range. So that's very common. And I'll just show 1 more example of that. So doji, here we got 3 more bars, and then we got a huge pullback. So that's just a very common occurrence. If you're looking to sell the doji, you have to be careful. There's probably not much left to the initial move. We're probably going to get more. For example, here we got 3 more bars and then a huge attempted reversal and a trading range environment, but then we eventually got more down. So that also is common, that we're probably going to get more down later, but if you're looking to scalp, it's probably only 1 to 3 bars left in that move. Now, I showed a lot of examples here of buying pause bars and dojis and bad reversal bars, but sometimes even good looking reversal bars in a new fresh breakout also fail. So here, for example, this is a very common occurrence when you're sideways at the moving average and you get a really strong transition away from it. We often get a pullback immediately. And I have a lot of examples of that. Like here, sideways at the moving average right above it, strong transition through to always in short. We often get a first attempt to reverse it, and that usually fails. So we talked about dojis. It's also true for reversal bars. When the context shows that we're probably going to get a second leg down from a strong breakout, you can sell this reversal bar as well. So sell the close of that reversal bar. And you can see what's very common is that it often won't trigger because so many bears are selling that close. So here as well, strong transition, attempted reversal, sell that close. You can see we didn't even go a tick above the close of that bar because so many bears sold it. So here we got strong transition through the moving average, bull bar. You can sell that close. You can sell more above the high. In this case, we did trigger it. But again, the point is that we know that the breakout above the microchannel is probably going to fail. So you can sell that close and then sell more above the prior bar. And usually it's better to sell above a strong bear bar. We're going to talk about that in a little bit. But you know that the microchannel breakout is probably going to fail on the first try. So you can sell that reversal bar, sell more higher, and make money on a scalp. Here as well, strong breakout. You can sell that reversal bar, sell more above the bear bar, and make money on a scalp. Now, the more we talked about how it often doesn't trigger because there's so many sellers there. If it does trigger, and especially if you get another bull bar to follow, so you get a reversal and a follow through bar, it increases the chances of a tight trading range. So it increases the likelihood that we're going to find buyers at the low close and create some kind of tight trading range. So this one has a strong reversal bar, and then we get follow through. Bull bar closing above its midpoint and closing above the reversal bar increases the likelihood of tight trading range. You can see that here as well. So reversal, follow through, 2 good bull bars, that's going to increase the likelihood of buyers at the low close. Now here's another example. Strong transition through the moving average, inside bull signal bar, bear sell that close. In this case, we didn't get reversal and follow through. So that's an easy sell and no reason to exit. You get 1 more leg down, which is what you expect. Here as well, transition away from the moving average, inside bull signal bar, bear sell that close. We don't even trigger the bull signal. Now here again, we have a trading range at the moving average. We're accelerating away from it. In this example before, I used the example of selling that close, but you can also just wait for the reversal bar. It's a doji reversal bar. A lot of bears just sell that close. We haven't gone above the bar in a lot of these cases. So if you're waiting to bet against the breakout and sell the high of the prior bar, you would miss that trade. But if you are aware of the context and you know that you can sell these reversal bars when the context is right, then you can make money even when we don't break above the microchannel. The next option, number 4, is micro trendline breaks. So what Al talks about in the book is that he talks about taking trades based on micro trendline breaks. But if you look at all the diagrams, they're also all micro channel breaks. So this is a micro trend line and it's four bars down in a micro channel. This bar that breaks the micro trend line also breaks the micro channel, and same with this one, and same with this one, and same with this one. So it's also enough to just look at the micro channel. And Al also talks about that in the room a lot. I know I haven't been in the room in the last year or so, but between 2017 and 2020, he often talked about not having too many lines on the chart, not worrying about drawing trend lines and micro trend lines, like especially the small minor ones. You just know that they're there, and you know that you can see from the micro channel that it's there. So you can also see that from these lines, there's actually there are gaps between the highs and the bars themselves. The highs of the bars and the line. So unless you're going to go down to the 1 minute chart and actually draw it perfectly, you're pretty much just looking at the micro channel anyways. And this is not my take. This is what Al actually says in the room, and even in the books, even in the book in certain areas, that you don't actually have to draw all these lines. You just have to look at the context and look at the micro channel, and that should be enough. Another area where Al mentions that micro trend lines can be used is when we don't break below the micro channel, but we break below the trend line and then create some kind of pause bar or inside bar, high one or low one. So those are situations where you also don't really need the trend line, but to know that we did try to break below it, and the breakout below the trend line failed. So here you can see if we draw this trend line, we got a couple ticks below the line, and then instead of reversing down or closing below it, we got a pause bar. Again, you didn't need the line to know that the pause bar is a buy the close, but in this case, if you're looking and you're trying to create a system or understand the market from the lens of trend lines, that's a reasonable way to look at it. So also here in this situation, we see a really strong breakout, and then this falls one tick below. I don't know if you can see it properly here, but it falls one tick below the trend line and then creates an inside high one. Again, I don't think you need the trend line. You just see the inside high one and buy the close or buy above, which is number 6 on the list. So these options are on the list already. I don't know if we necessarily need the trend line, but I'm just for completeness, I'm sharing it. So here as well, you can argue that it's a micro trend line and that we're getting one tick above, it's a micro trend line, and this bar opens above it, but then fails immediately. And so you can take that sell as a low one sell, but it's just a low one sell. So I don't know if you need the trend line there. Here again, it breaks the trend line, but it's already a micro channel. So you can just buy below that bar. Here as well, micro channel, just buy the low of that bar. The trend line is not super important there. So one area where it is actually useful to draw the trend line is if you're going to use it to draw a channel line. So it'll give you a sense of where the move is likely to end or where it's going to stall. So when you're using it to draw channel lines, it does make sense because it's giving you some kind of predictive value of where the price is going to be contained within. But in terms of actually trading the microchannel breakout, Al makes it clear that you don't necessarily need to make trades off of micro trend lines. Most of the information is in the bars of the chart. So now we're going to look at number 5, which is buying the low of the prior bar and lower, betting that the first breakout will fail. So betting on a failed breakout of a microchannel, this is the official breakout. So we've fallen below the prior bar. We're betting that's going to fail. And what type of bar are we fading? So urgency will determine what bar type you're willing to fade. So in high urgency situations, like early in a microchannel, when you have really strong microchannels, when we're early in the market cycle, when you have fresh breakouts, you can fade any bar, even an opposite bar. And we've talked about that. So when we talked about number 3 here, buying a reversal bar or selling a reversal bar, we talked about how when you have transitions away from the moving average or just new strong breakouts, you can often just sell the close of the reversal bar in all these situations. So there's strong reversal bars, but you can sell them. And in situations like this, when the difference between selling the close of the reversal bar and selling above it is so small, there's not really any point. I think it's just worth it to sell the close so you don't miss a trade, because a lot of times we don't trigger above it and then look to sell above a strong bear bar in these situations, or buy below a strong bull bar in the bull case. So this is actually more important in situations where the signal bar is kind of uncertain, and selling the close of the signal bar is actually a decent distance away from the high. So if you don't want to sell low, and let's say this was a big tail on top, and you didn't want to sell like a wide range doji, kind of like this, the start of this right here. So you have 3 bear bars down, probably gonna get a pullback. You look to sell in the sell zone, and here you would have gotten filled. But let's say you're waiting for the doji, and it's such a wide range doji that it doesn't look like a small pause bar of acceptance. It looks more like a wide trading range. You may say, okay, I don't want to sell the close of the doji, I want to sell above it. So in situations like that, where selling the close and selling above are a decent distance away, it makes more sense. But in situations where it's a matter of a couple ticks, I think it makes sense to just sell the reversal bar or buy the reversal bar. So here you have a transition through the moving average and then a pullback, which is expected. And you can buy that low, betting that the breakout below will fail. Here you have a bull signal bar, but it's probably going to fail after a transition through the moving average. So you can sell above that. But in both these cases, the difference between buying this close and buying below, and the difference between selling this close and selling above is so small, I think it's worth it to just buy that close and sell that close. And then look to, here in this case, buy below the bull bar, and in this case, sell above the bear bar. So here, really strong breakout, and we fell below a reversal bar. Technically, it closes below its midpoint. It's still reasonable to buy below that, or even buy that close, because we're probably going higher. So here, really strong microchannel, really strong breakout. You can buy that close. You can buy below that bear bar. You can pretty much do anything, betting that we're going to go higher. So reversal bars should not scare you out, which I have a whole video on this about getting scared out of these trends and how to approach them. But that was a couple years ago, so I think I have a better grasp of this now, and that it's very okay to do this, to buy this close, to buy below this, betting that the breakout will fail, looking for more up. And here as well, strong breakout. So 3 strong bars. Again, we get a pause bar or a reversal bar, which is very common. Here you would not get filled in the buy zone. And instead, if you fade that reversal bar or buy that close, you get one more leg up, which is expected. So in high urgency situations, you can buy below any bar pretty much. Any opposite bar, any doji, it doesn't really matter, because we're probably going higher. And if it's reasonable to buy the close, you can buy below it. It doesn't matter what kind of bar it is in high urgency situations. Now in low urgency situations, like microchannels and trading ranges, late in microchannels, when we have a completed or a mature internal structure, or weak microchannels with high overlap and pauses, that's when it gets a little bit more nuanced, and that's when it becomes better to buy below a strong bar in the direction of the microchannel. So in the bull case, it's better to buy below a strong bull bar. And I have a full slide coming up here to talk about why using strong bars is useful to fade in a microchannel. But one reason in terms of risk control is that it mitigates the risk of late legs, parabolic wedges, and climaxes. The downside is that it's lower frequency. So if you are being more cautious, you're waiting to buy below a strong bull bar, there's obviously a greater chance that you won't get filled. So if you're making an assessment that this is not an area where I should be trading aggressively and I should be more cautious, then you increase the chances of missing the trade. So this is a situation where it's not necessarily high urgency, but the context is good. The bottom of a trading range, failed breakout below the bottom of the trading range. And it's reasonable here to assess that this is a weak microchannel. So you're going to look to buy the bottom of the last strong bull bar, and you would miss this trade. And that's completely okay, because this is not high urgency. This is. So when you get bull breakout and follow through, then you can start buying. And here, if you're trying to get the best price below a bull bar, that's very reasonable. And then here as well, we have a spike in channel, double bottom bull flag at the moving average. And then we get a 6-bar bull microchannel, not a strong microchannel. So we can see a move up, pause, another move up, pause, and a third move up. So it's a parabolic wedge on a lower time frame, but it's the start of a possible new move up. So not strong urgency here. Weak microchannel, probably best not to buy closes, and better to wait to buy the low of the last bar. So fade the microchannel. So you're buying the low of a strong bull bar in the start of a possible new move, and at the moving average, that's a good fade below that bar. As I'm going to mention in the next slide, fading strong bars in microchannels is typically a good idea because it's very forgiving, and that's what makes it a really powerful tool when you're trading counter trend. So I mentioned before that microchannels against a trend can fail very often, but in the right contexts, it's often a good idea to fade a strong bar. So you can see here, after consecutive climaxes, we have 3 climaxes down, and now we're reversing up. So we're probably going to get 2 legs up to the moving average and to the high of the last sell climax. You can see we reversed up from the low of the last strong bull bar. So in situations where we have a strong microchannel, but it's not necessarily an urgent situation, so we're counter trend, we're in a developing trading range, we might get a deep pullback to test lower prices. In those situations, it's usually most effective to look for a strong bar to fade. So you can see we reversed up from the low of that strong bull bar. And here as well, we had spike in channel down, reasonably strong microchannel up, but still a tight channel down. So we might test down a little bit lower. Instead of buying that close or looking to buy high, it's not an urgent situation. And we're probably going to pull back in a developing trading range environment. So yes, we're probably going to get a second leg up, but it might be a deeper pullback. In those situations, it's usually best to fade the last strong bull bar. So here's an example where it looks very strong and it looks like there's a lot of urgency. But once we have an inside bar, so we have an inside bar, here we have a pause bar, we're also like 10 bars into the microchannel, that increases the likelihood that we're going to fall below a bull bar. So when you're late in a microchannel, the chances of going below a strong bull bar are higher. So instead of buying the close of that doji so late in the microchannel, it makes sense to buy below a strong bull bar. So why strong bars? Why are they important? The reason that strong bars are important is because they're the start of a strong or a significant leg on a lower time frame. So when you look at something like this, you get 3 strong bear bars. On a lower time frame, this is actually leg 1, pullback, leg 2, pullback, leg 3. So this was a leg of its own on a lower time frame. And so when you get to the high of a leg, it's often going to be the top of a trading range on a lower time frame. So we're often going to get sellers there and start to go sideways. So selling the high of a strong bear bar in a bear microchannel is selling the high of the last strong bear leg on a lower time frame. So it's a very good area to expect sideways or more down. Here's another example. So 3 strong bear bars. Some will sell the close, not a good idea at the bottom of a trading range, but strong enough spike that we're probably going to get a second leg down. So some bears sell in the sell zone and some bears sell above the high. So on a lower time frame, this is a new breakout, leg 1, leg 2, leg 3. Very reasonable to sell at the high of leg 3 where it's likely to test and look for a second leg down. So this is an area where if you did sell the sell zone, you would have had a little bit of a drawdown, but the sell zone here is a reasonable trade. The selling the high of the last bar is a reasonable trade. Again, they're all individually reasonable trades to take. It's just about, based on the market context, how patient are you willing to be to get the best possible price. The second reason why it's useful to sell strong bear bars in bear microchannels and buy the low of strong bull bars in bull microchannels is because they're obvious areas of interest. So there's obvious enthusiasm. We talked about it from the perspective of the leg structure. So on a lower time frame, it's leg 1, leg 2, leg 3. There are probably sellers at the high of the last leg on the lower time frame. But it's also an area where when you see a strong bear bar like this, there are obviously a lot of sellers at that high that sold aggressively. So we know that there are sellers there. If you have a doji, for example, it's an area of agreement. It's an area to facilitate trading, but we don't know that there are aggressive sellers there necessarily. Whereas when you have a strong bear bar, you know that there are aggressive sellers there because the last time the price was there, it accelerated down. So it's a reasonable area to sell. And same with here. We have strong bull bars on the way up. We know that at the low of this price, we shot up. So there are probably buyers at that price. Whereas here, we don't have that kind of information. We did shoot up, but we shot back down and created a doji. So it's more of an area of agreement. It's a trading range. Whereas here, all we have is strong buying to create this bar. So it's a reasonable and a really effective way to trade microchannels is to look for a strong bar in the direction of the microchannel. So another reason why it's important to use strong bars is that they often give us more information. We get to see the approach to that bar. So here, for example, if you bought this close, or this is a minor reversal in a bear move, so you have to be more careful. But when you place a limit order to buy the low of a strong bull bar, you get to see how it approaches. So in this case, we see that we get the approach is 2 legs down. So it's higher probability to see 2 legs down without a good sell signal bar. Whereas if you just buy the low of that bar, you don't really get any extra information. So we're high in a trading range at this point. It's the first break, first gap bar, and you're buying the low of that bar without seeing much. By placing your order further away, you can see how it approaches it. And here it approaches as a leg in a trading range, 2 legs down. It gives you more confidence to place a limit order there and buy. Here as well, this is kind of a trading range environment. You could sell this high, betting that it's a micro channel, but we're low in a trading range. So if you want to get a better price, especially in a trading range where you want to sell in the upper third, remember we talked about how microchannels and trading ranges actually put sellers in the upper third. Now, if this broke out to the downside, it's a different story, but we didn't get a breakout here. We just went sideways and then got an upside breakout. But this microchannel puts sellers up here in this area. So by selling the high of the bear bar, it protects you from selling too low in a trading range and also gives you many opportunities to exit break even or to manage the trade. because you get to see the approach. So you see the approach as a big, strong bull bar approaching your entry. Maybe you pull the order, or maybe you see that and then you exit after. So because you see the approach, because you get more information, you can manage a trade appropriately. Similar situation here. We are in an expanding triangle in a trading range, and you see this microchannel and you think it's worth fading it. You can see that the approach comes up with 3 bull bars, and then you get a 4th bull bar, and we went sideways in this area. So even if you did do that, you were able to get out break even, or even with a small scalp if you sold that high and more higher, and then it came down and filled your first order. So it's very forgiving to trade microchannels using the last strong bar in the direction of the microchannel, because you see the approach, and you also usually get a decent chance to exit with a small profit or break even. And if you look at these microchannels, a lot of them do reverse from the high of the last strong bear bar. And so when I mentioned here that it mitigates risk of late legs, parabolic wedges, and climaxes, this is kind of what I mean. So when you're looking for a really good price, so here you can see that we start off with overlap, we get a strong breakout, pause, another strong breakout. So you could argue that's a parabolic wedge. If you sold the high of the bull bar here, betting that it's a microchannel and the first breakout should fail, you're not getting an ideal price. By selling the high of the bear bar, you're protecting against the fact that it's a parabolic wedge, and that even if you're wrong, that you're probably gonna get a good price and probably get more information on the way up, so that you can manage a trade appropriately. So it's often a really good choice when you're uncertain about the microchannel. It's not obviously a fresh breakout. You don't feel certain about the market context, but you still see that it's probably going to get some kind of sideways or second leg down. Selling the high of the last strong bear bar is a good option. So the last option here is that it's very forgiving, which we just talked about in climaxes and parabolic wedges, especially in trading ranges. And it also usually gets tested later. And that's important for many different reasons. One is that for traders who use wide stops and scale in trading ranges, you can often sell this high and bet that we're going to come back down and test it later. You can also often buy this low and bet that we're going to come back up and test it later. So for traders who are trading that way, it's reasonable. I wouldn't recommend it. It's not something that I typically do. I don't feel comfortable doing it, but I know there are traders who do trade that way. And Al will often talk about that in the room, that it's reasonable to do that. But I think the better option for most traders is to not take the first one and know that we're probably going to come back up and test there. So not take the sell, know that we're probably going to come back and test down, and use that to structure a trade, and not necessarily take the first limit order fade in a microchannel. In a microchannel in a trading range. But you can see that often when you do take the limit order at the strong bar. So here, if you sell that strong bear bar, if you're disappointed, you can exit break even. Here, if you buy this strong bull bar, once you see reversal follow through, you can exit break even. So that happens very often. Even here, so this is S2, second spike. We have a doji and a bigger bar, so probably tight trading range or pullback. Now, let's say you see this as a microchannel and you want to buy the last strong bull bar. So, and that is recommended after a doji and a final bull bar. At that point, you want to move down the list and become more cautious. So this is also like, if you see, this is order of urgency. So highest urgency to lowest urgency, but also it's an indication that if you see these things, that the microchannel is getting weaker. So at this point, we had the micro trend line break and the pause bar. So we've had 3 and 4 already. So now we're at 5. So it's best not to do any of these things anymore. 1 through 4. Now you should stick to 5. With 5, 6, or 7. In this case, 5 didn't work very well. However, if you took it, which was reasonable, you can see that once you got reversal and follow through, we got back up and tested it and got above that low again. So if you did do that and you saw reversal follow through 2 bear bars, you could have gotten out break even. So that's why it's a forgiving trade to take. When you work down that list, it's still reasonable, and usually it will give you an option to exit break even. So this is a little bit repetitive. I've talked about this throughout the chapter, but I want to just make a quick list just of when to be cautious fading microchannels. So the first option is be cautious when betting on a failed breakout in a trading range. So situations like this, bull microchannel betting on a failed downside breakout, or bear microchannel betting on a failed upside breakout, you have to be more cautious in trading ranges, because first reversals often work well in trading ranges, and you might often get a deep pullback. So you have to be careful when fading microchannels below the prior bar in a bull microchannel, above the prior bar in a bear microchannel when you're in a trading range. The second one is when betting on a failed breakout of a microchannel with a completed internal structure. So we talked about that early. You have a microchannel like this, and the internal structure is complete. So you have 3 legs up, internally because of the pauses, it's usually not a good idea to fade the first bar. It's better to look for more information. So here as well. So it's a microchannel, but we have pauses creating 3 legs, a completed internal structure. So buying that last low is usually not the best option. Usually buying strong bull bars on the way down is better, but you still have to be more cautious. You have to expect a deeper pullback and understand how to manage that trade if you do that. But these are times to be more cautious when we're later in later legs and when we have completed internal structures. That's especially true when you're trading counter trend, which is obviously more advanced. But when you're trading counter trend and you have completed internal structures, you can see that even if bulls bought that low for the microchannel, they were still able to get out with a scalp if they bought more lower. But typically when you have a complete internal structure in a bearish environment, you're more so looking for a bear breakout to sell a pullback and not necessarily to buy for a bull scalp. So being careful of a completed internal structure is most important when you're trading counter trend and also when we're in late legs. So for example, here this is spike and channel, and this is a completed internal structure in the channel phase of leg 2. So it's higher likelihood of getting a deeper pullback. Whereas in a situation like this is a completed internal structure, but it's bouncing from a double bottom bull flag at the moving average. So this is a start of a possible new move. So it's better to fade that low versus this where it's already completed the channel after a spike. So we're probably gonna enter a small trading range here. So it's depending on the environment, if it's counter trend and if it's a later leg, it's more important to be careful of internal structure. The third option here is when betting on a failed breakout of a microchannel with a completed market cycle. So what I mean by that is this is all one microchannel. It has a spike phase and the channel phase all within the same microchannel. So this is actually a completed market cycle. It's a spike and channel, but we never break below the prior low. So if you're just looking at fading the last low, you have to understand what has happened leading up to that. And here, if you fade this last low, this is actually the end of the channel phase. So yes, we do get one more leg up, but you can see that it wasn't from this bar or this bar. It was from the last strong bull bar. And so you can bet that we're going to go sideways here, but you have to be more cautious when the market cycle is actually complete within the microchannel. So be more cautious. If the context is good for one more leg up, then you can take it. But it's usually best to then look to buy below strong bull bars or wait for more information. So the fourth option here is be careful and cautious when fading microchannels when you're betting on a failed breakout during a flag, especially at the moving average. So here's an example of that. So we have a completed structure, technically 3 legs down and double bottom bull flag, but right at the moving average. So typically these fades are better when there's room to the moving average and the structure is complete. In this case, the structure is complete, but we're at the moving average. So you have to be really careful about fading these. Here as well, moving average, microchannel to the moving average doesn't get much of a second leg, maybe a scalp here, but we immediately get a breakout pullback sell for the bears and we get more down. So when we're at the moving average, that's typically the end goal for a lot of these flags. So if we already get there and the microchannel gets there on the first push, we might get some sideways, but you have to be really careful when we're in a bear environment and there's strong selling pressure or at least a tight channel down, that if you're trying to fade a microchannel at the moving average, you have to be really careful and really quick. And for most traders, again, this is more limit order trading stuff, and it's usually better to save that for when you're really comfortable with managing trades. And so here we have a spike and channel, and this whole thing is strong enough for a second leg up, and we have a 6-bar bear microchannel against that bull move. So the expectation is more up. We have a 6-bar bear microchannel at the moving average, so it's a bull flag at the moving average. And so even though it's a bear microchannel, you want to be really careful fading these and probably best to skip, especially with 2 internal legs down. It's best not to take flags or fade flags at the moving average against the direction of the expectation. So here the expectation is second leg up. We have a bear microchannel. It's probably a bull flag. So it did work in this case, but in most cases, it's best to skip that. The next option here is when betting on a failed breakout after a potential top or bottom formation. So here, for example, we have a 6-bar bull microchannel, but you can see the spike, the pause, and then 2 more pushes up. So we have a spike and channel all included in here, and we have the pause and second leg already. So when we have the pause and second leg all within the microchannel, it's technically already a type of top formation on a lower time frame. So you have to be more careful. Now, again, in this case, if you bought the last strong bull bar, you were okay to exit break even when you were disappointed by this. But in most cases, once the microchannel has some kind of top formation, like a doji and 2 small legs up, or a pause and a micro double top, it's better to let that go and wait for more information here as well. So doji, 1 more breakout, and then small micro double top. It's probably best not to buy that low at this point. because we've had a completed top formation on a lower time frame. So it's better to wait for more information in this case. And finally, when betting on a failed breakout after consecutive climaxes. So these coincide with the examples I talked about earlier when a breakout is likely to succeed on the first try. If the breakout is likely to succeed on the first try, it's usually better not to fade it. And climaxes was another example of those. So when we have consecutive climaxes down, that breakout of that last microchannel is more likely to succeed. So it's better not to fade that, and actually better to take the buy after a reversal follow through or just a reversal bar, because we're probably going to get a couple legs up to the moving average and the high of the last sell climax. So now we're at option 6. So a little bit more conservative than fading with a limit order. Now you're waiting for the breakout to fail and give you evidence that it's failing. All of these are pre-evidence. You don't actually see the failure. You're actually trading with limit orders and waiting. Here, you are waiting for it to fail and create a high one buy signal or high one breakout. So we have a strong microchannel. You don't want to trade, if you don't want to trade with limit orders, you wait for the first push above the prior bar. You wait for it to fail and create a sell signal. In this case, it's a bear microchannel, and you sell that, looking for one more bar or one more leg down. Same thing on the way up. Strong microchannel. You don't buy below the prior bar. You wait for more information. You see the bull signal bar, you buy that, looking for one more bar, one more leg up. So these are reasonable stop entry buys. You can see that you're getting 1-to-1 on these. They're very high probability for stop orders in that way. Also, if you're swing trading, you can also use your stop above the spike and use it as an entry for a swing trade. But in these situations, again, I mentioned that this is leg 3 in a larger bear channel, so not the best idea, but that is a viable option as well. So again, you see here, strong spike. You don't trade with limit orders. You wait. You get this breakout. It doesn't close below, but it's not a great signal bar. So you wait. You get a good signal bar here. You take that buy. So this is a more patient option. It's for traders who are looking to trade with stop orders, and they want to see evidence of failure first. So the breakout is failing to the downside. I want to see evidence of that. I want to see it start to reverse up, and then I'll take the trade. And another option here is to not wait for the high one signal bar and just wait to see what the breakout bar looks like. So wait for the break below the microchannel, see what that breakout bar looks like, and then you can just fade the breakout. So you fade the first breakout against the microchannel, but not with a limit order. You wait to see the bar close, and then you fade that bar. So that would probably go somewhere in between 5 and 6 as like 5.5. It's less aggressive than using a limit order to fade the breakout, and it's more aggressive than waiting for the breakout to fail and create a high one signal bar. So you're not waiting for the high one signal bar. You're just seeing the bar break out, seeing what the bar looks like, making sure it's not a huge bear surprise, and just buying that breakout bar. So here too, you have a bear bar against a strong spike. That first breakout is probably going to fail, so you can just buy the close of that bear bar. Now again, this is just a way to engage with the microchannel. So it's a way to get long in a situation where we want to get long. But knowing when to get long, what leg it's in, what the market cycle is doing, what the overall environment's doing, those are things that have to be taken into account. This is just a way to actually trigger the buy when it's a right time to get long. So if we go back to looking at it through the lens of buying the high one after the breakout fails, in this situation, we have a strong microchannel, strong breakout, pause bar, and then one more bar, which is what we expect. And then bear breakout should fail, but we're not going to bet on the failure with a limit order. We're going to wait for evidence of the failure. We get a high one buy. In this case, you might say big bear bar, big bull bar. I want to see a little bit more. You get one more bar and you buy that. So that's up to discretion and your own trading style. If you want to wait for more information, you can do that. If you buy that and you have a stop down here, it's not an issue. So it depends on where you put your stop. Depends on how you're trading it. So here as well, we get a strong breakout. We don't trade with limit orders. We wait for the breakout to fail. The bar closes near its high, but it's a doji and a bear body. So maybe you wait, take the next bar. But this is also reasonable to take, especially if you're using a wide stop. And again here, this is from a few days ago. Strong breakout. Wait for the pullback to fail. If you want to trade with limit orders, you can buy the low of that bar, which we talked about. You can buy the close of that bar. You can buy the breakout point. If you want to wait, you wait for the reversal up, evidence, and you buy that close, buy the next close. In this case, we're probably starting a trend up for a trending trading range day, so we're probably going to get higher. In these cases, it is reasonable to buy either of these or both. Whereas situations like this, when we're more in a trading range environment, you probably don't want to trade you want to trade the low one, not the low one breakout. You want to trade the high one, not the high one breakout in trading range environments. Whereas in trending environments, you can be much more flexible with trading the high one breakout, and expecting more up. So here, trade the high one breakout, expect more up. Here as well, the high one breakout, expect more up. And just more examples of that. Strong breakout, wait for the high one, buy the high one breakout, and look at the response. It's 4 straight bull bars. So this bar, even though it's considered a second entry sell, it wasn't timely. It wasn't at the right time. It should have been a little bit earlier. So in this case, we're probably actually going higher. Now, so
I mentioned high one and high one breakout. This is what leads to the next option. So when we talk about the resumption failing, the resumption fails based on the response of the high one breakout. So here we have the first failure. So we have the first breakout failing, going to a new high, in this case a higher high, and we have a high one breakout. Now what's the response to the breakout? That's important. Is it strong continuation immediately? Is it a pause bar to indicate acceptance and a possible buy the close in this case? Is it a strong bear reversal bar? And if it is a strong bear reversal bar, what was the last reversal bar like? So in this case, it's all bull bars and a doji sell signal. Even though it's technically a bear reversal bar, it's a bull body and it's a doji. So the first reversal is not very strong. Even if this was a bear bar, it probably wouldn't be a strong second entry sell, considering we rallied so strongly. So the response is very important. And also, once you get a good sell signal as a response, you want to see what the last breakout was like to gauge if it's actually a good sell or maybe it's just a good exit. And here, this is a really good example of that. So we have a new breakout right here, these two bars. Now we have the low one, that's a good sell. We have the low one breakout. Now what's the response to the low one breakout? It's a doji. A lot of bears you can see sold that. Because if first of all, this is a microchannel still, so we never even got the first break. But if we did get the first break, and this was a different environment, if it was a trading range environment, we got the first break, and the low one breakout bar got a really strong bull response, that would end up being a second entry buy that you could take in a trading range day. Here you can see that you're trying to sell, you're waiting for a reason to sell, you could sell that, or you can wait to see the response to the breakout. See, it's a doji, it's not a strong bull bar. So bulls are not in control. They're not getting the second entry buy. In this case, it wouldn't be one anyways because it didn't go above the prior bar. But you see the response, and that's a good response for the bears to sell the close. But that is an important piece because in trading range environments, if the high one breakout fails, like this, for example, so the high one breakout gets this kind of response, it becomes a second entry. So one other example of the high one response is this situation here where we have a spike break and then a high one buy, a high one breakout, and the response to the high one breakout is not very strong for the bears, so it's a possible buy the close. Now, given the context, it's not a strong bull trend. We're actually in a bear channel, so we could be at resistance. It could be a minor reversal. But even if you did buy that close looking for more up, the next bar is a bear inside bar for a second entry sell. So you can see that this tail on bar 43, the next bar after the second entry sell, it went up and it let traders out who bought that close. So there's nuances of when to buy the bad response to the high one breakout. There's also nuances of when to exit. So what you'd have to see to want to exit break even. So again, not a full system. This is just ways to engage. And then based on context, you would take those trades and exit those trades appropriately. So here's another example, breakout follow through, doji for a contingency entry. So still haven't fallen below the prior bar, but still reasonable buy the close there for at least one more bar. Now we have one more bar, pullback. So now we're waiting for moving down the list, waiting for a high one or high two. We get the high one buy here, and then we get the high one breakout. And you can see that, especially on the open, and I highly recommend watching the recording of this day when Al was talking about it because he talks through all of these different steps. But we have the high one breakout, but you have to be aware of a parabolic wedge on the open after a gap up. So the contextual factors say that we might be more so in a trading range environment up here on the third push up rather than looking for a continued trend up so far from the moving average. So, but even if you did take it, you can see that we got the bear bar, so bad, not a good response for the bulls after the high one breakout, and a decent response for the bears. It's a bear signal bar, parabolic wedge, second entry. So two strong bear bars. You can see that bulls tried to exit on the high close, and then we got a second bear bar. So you have to read the high one breakout response and see what the bears are able to accomplish given the context. And in this situation, the bulls were sufficiently disappointed by the response and the attempted test up and then subsequent bear bar, and then everyone exited. Now, the reason why high one is low on the list is because it's more cautious. So here, we got the doji, we got the last bar, and so now a lot of traders will wait for either the low of the last bull bar or they'll wait for a high one buy. If you wait for the low of the last bull bar, you'll get trapped in this case, which is part of it. Like that will happen if you trade with limit orders. But if you're more cautious and you're waiting for a high one, it never comes. So that's why high one's lower on the list. If you want to be more cautious, if you want to trade with stop orders, you wait for the breakout to fail and then you take the trade. And in this case, it never came. So in a situation where you'd expect more up, if you were cautious, you were saved and protected from a trap trade. And now you get a microchannel against the microchannel. And so now we restart the process. So when you get that, now you say, okay, first breakout is probably going to fail. Wait for a second breakout, second entry second entry buy, and then you take the SPY down here. So now the whole cycle just repeats itself, and we start back at the beginning. Is this breakout likely to succeed? Probably not. After a bear microchannel, wait for a second entry. after this move is probably going to get a second leg up. So look for a second entry. Here's another example. Really strong breakout. All the rules we talked about earlier all failed here. So 3 bars up, look for the buy zone. If you trade the buy zone, you might have gotten a small scalp here, but probably failed. You probably lost money there. If you bought the sell signal, probably lost money. If you bought below any of these bars, probably lost money. But if you wait for the high 1 or high 2, you didn't lose money. So in this case, you're protected from it. Now, even high 1s fail, and even high 1s are not pure protection. They're still losing trades. So here we have a microchannel down. We get a low 1 sell, low 1 breakout. It broke out below the low 1 signal. It did not break out below the low. So that's a sign. But also we're at the bottom of a trading range, and we had big up, big down. But even then, even if you thought it was going to get at least a little bit more down, you have to know how to exit these trades. So you're taking a low 1. It's protective in a certain sense from limit orders and from getting trapped in those ways. But low 1s are not perfect either. So you have to know what it's going to look like when it fails. And if you get a low 1 trade, look at the response to the low 1 breakout. It's a bull bar and then follow through. So when you're at the bottom of a trading range day and you get that, you have to be a lot more careful and know when to exit those trades.
So high 1 and low 1 considerations.
You have to know when to avoid them. So the depth and the quality of the pullback is important. Typically, for all these successful high 1s and low 1s, you want them to happen within a bar or two. So you get the breakout, it fails immediately. You get the downside breakout of a bull microchannel, it fails immediately. That's the best case scenario. We don't get much selling pressure against the bull microchannel. It's just an attempt to break out, it fails right away, and then we get buying. So you typically want it within a bar or two. And Al says it's typically the bar that creates the breakout. You should trade below that bar. So in a bear microchannel, this bar creates the breakout. You should trade below that bar when it fails. So below that sell signal. Here, it's this bar that creates the bear breakout. We close on a high. It's a buy above that bar. Here, it's this bar that creates the bear breakout. So technically, it's a buy above that bar, which is actually reasonable in a strong spike like this. But you can also wait for a strong bull bar and then buy above that. Now, what you'll notice about these two failures is that if you follow Al's rules exactly, you would not get trapped in this. So you wouldn't get trapped in this either. So here, you wait for it doesn't go above any of these bars. So if you're waiting for that breakout bar to be triggered above, whether you trade above a bear bar or a bull bar, in this case, you would not be triggered. So you'd be saved from that using Al's rules. So here, you're just waiting for it to go above a bar. It doesn't happen. So buying above a bull bar in a bull microchannel is better. Selling below a bear bar in a bear microchannel is better. But even if you're using just the rules of trading above a prior bar here, you would have been protected from that as well. So the depth and the quality of the pullback are important. The number of the bars against are important. And are they trend bars or are they trading range bars? So what that means is, are we getting a directional move? Are we failing to break out and then getting a directional move like this with a sell signal, a directional move up with a buy signal? So here we have a bear bar. It's kind of a doji. It's not very clear. But then we have a bull bar. So we have a directional move. So are we getting that kind of move? Big bear bar and then bull bar. So we're getting directional moves here. Even though this is a doji, we're getting a failed breakout and then we're closing near the high and then we're getting a quick breakout. So that's different than a breakout leading to 6 sideways bars, for example. So you want to make sure that if you're taking a high 1, you're not taking a high 1 after 3 dojis, that you want to see a failed breakout and an immediate rejection.
So some examples of taking depth and quality of the pullback into consideration are right here. So we have a strong microchannel, strong breakout, and we get a breakout, we get a doji, but it's a trading range environment. So you probably want to wait for a deeper pullback, maybe a high 1. But you can see the high 1 is coming after 2 bear bars. So it's a bear doji, a bear bar, and we cover a long distance. So it's a deep pullback. It's coming after 2 bear bars. This is a situation where you might want to skip the high 1. Now, if you use the stop down here, you can buy above a high 1, keep the correct swing stop, and in situations where we are going to get a swing, you're going to be okay. But if you're being conservative and trying to trade based on the expectations, we're probably going to get a small second leg sideways to down after this. So you don't take the high 1, you wait for a high 2, which is the second time it goes above the high of the bar, but this is a surprise. It's 2 bigger bear bars. So you wait again, and then you take a wedge bull flag instead, which is this third bull signal or the breakout after the third signal. So that's how you read the price and adjust based on the depth of pullback. And then context is obviously something to keep in mind. So the microchannel itself, so here we had the 3 bar breakout. We entered the buy zone. We got a doji, so that was buy the close. This is also an inside bar high 1 breakout. All of those worked. And then we get a bigger bar and a sell signal, and then an inside bar high 1. So we have an inside bar high 1 after we've already had one inside bar late in a microchannel, and that's often a good enough reason to pass on the high 1. If you did take the high one and use a correct stop, you're fine, but that's often a good reason to pass on it and wait for a high two. And then the second time we go above a bar is right here. It's a good signal bar, and that's the one that leads to the move up. So here's another situation, looking at gauging the response or gauging the pullback. So we have a strong spike up in a trading range environment, and we just crossed to the moving average. So maybe wait for a pullback for a high one. The high one is coming after 2 bear bars. So we triggered this buy. It's a reversal bar technically because it's closing above its midpoint, but it's coming after 2 bear bars. So maybe you wait. You can also take it and use a correct stop because we just transitioned through the moving average. But again, trading with expectation after 2 bear bars, not usually the best call. Wait for a second entry, which happens up here. And then here again, 3 bars, got the pause, the breakout, got us a bigger bar. So bigger bar and then high one. After a sell signal that travels a decent distance, you might wait for a high two. So you wait for the first bar to trigger, get the second leg down, and then take the second entry. And that's what we're going to talk about as number 7, which is second entry options to engage. So here, microchannel, it's really, really deep distance. So it is technically a high one, but it's a doji coming after a really deep pullback. So you wait for the second entry, and you get that buy there, which is the one that actually led to the move up.
And then finally, knowing when to exit. So you have to be ready for that resumption to fail, especially in certain contexts, right? So we talked about that here. We're betting on resumption with the low one, but based on the context, you have to be ready for the response to the low one breakout or the high one breakout and know that there's a chance it's going to fail. And if you're still short at this point and you see this, you have to exit, especially with follow through. And same thing here. If you're long here looking for an immediate move, if your stop's below here, you can't stay long through this because we've had the we've had the high one breakout. It's a minor reversal, probably going to test down. So you have to be careful when the response to the breakout is weak and we end up getting a second entry sell in this bull case. And here, this example I showed earlier, low one, you're taking the low one breakout, not great in this environment. But if you do, you have to look at the low one breakout response, which is a bull bar, and then follow through. So you have to exit. And again, this is very context dependent, right? So if you're trading at the bottom of a trading range, you have to be quicker to exit. If you're swing trading and it's a clear bull trend, then you might be willing to sit through a 10-bar pullback to the moving average. So in those situations, you may not panic out just because the high one failed for now, because you might get a high two later or a wedge bull flag. So depends on the context, depends where your stop is, depends how you're managing the trade. So now we're on option 7. So after option 6, where we're trying to buy a high one in a bull microchannel or sell a low one in a bear microchannel, there are situations where you'll be waiting for the high one, for example, in the bull case, to trigger, but it doesn't come. So in this situation, for example, we have a bull microchannel, we're waiting for the high one, it doesn't come. Instead, it becomes a bear microchannel. So we talked about how when to avoid high ones and low ones is to look at the depth and the quality of the pullback. So number of bars against is one example. So when you're trying to take this trade cautiously, wait for the high one, and never comes, at this point, we get the high one here, it goes above the prior bar, but now it's a microchannel of its own. So now this has to be taken into consideration as a new microchannel against this microchannel. And that's when we get to option 7, which is it's better to buy above a high 2 after the breakout fails. So in this kind of situation, we get to number 3, the third option, the fourth major option for attempted reversals or breakouts. So the first breakout is probably going to fail. We're going to look for the second breakout or the second reversal. So that's where we're looking for the resumption to fail and create a breakout pullback sell or a breakout pullback buy in the bull case. So here we're waiting for the high one, doesn't come, becomes a microchannel. Now we're waiting for the first breakout to fail and looking to take the second breakout or the second reversal. Now, this is where we have to take into consideration the stuff we talked about earlier, which is this likely to have the first breakout succeed? Let's look at the internal structure. Internal structure is not super consistent. There are tails here that would indicate that it's 3 pushes down, but we're getting a lot of consistency. It's straight bear bars, and it's not very clear. We're not getting opposite bars to show a completed internal structure. It's also leg 1, so it's not a late leg. So in this situation, you're going to wait for the first breakout to fail and look for the second reversal, the second breakout to succeed. So we need a breakout, a pullback, and then a bull bar, or you can wait for the strong breakout here with 3 bull bars and start to buy then. But either way, you're waiting for the resumption down from this microchannel to fail and then take the trade in the direction of the preceding trend. And you can see here that when you start to combine everything, so you see the first breakout fail, looking for the second entry. Maybe you don't want to take the second entry because it's coming after 3 bear bars. So you wait and you get the bull breakout, 3 bar bull microchannel. So you can buy the close, but because we're just breaking above a swing point, you can also wait to buy a pullback. And you can see that we bounced right from the low of the last strong bull bar. So when you try to combine all these things together, it really starts to make sense, and it gives you a sense of the building blocks that are forming all of these patterns. So in this example, we have a strong microchannel,
a break below, failed breakout, and then a second strong microchannel. So we're still looking to buy. It's a very strong move up, but we know we're in S2, and S2s typically get deeper pullbacks. So you might wait for more information. You don't want to buy the close up there necessarily. You also don't necessarily want to buy in the buy zone after 3 legs up here, but then also 2 spikes. So you wait for more information. You wait for a high one that never triggers. So by waiting for more information and knowing when to wait for more information, you end up getting a much better entry. So here you're waiting for the high one and never triggers, ends up becoming a 7-bar bear microchannel. And so now you know the best bet here is to wait for a breakout pullback buy. And so we get a breakout, trend bars up, closing above a bull bar, and then attempted trend resumption down. Resumption fails, and we get a bull bar with follow through. So that's a relatively easy buy there. So same thing here in the bear case. You have a bear microchannel. Now, if you're trading with limit orders, you could sell the high last bear bar and the bear bar before it as well, and then eventually you'll get down for a scalp. So you'll make money if you're a limit order trader. But let's say you're waiting for a low one because you want to be careful and you want evidence of the failed breakout above. Here we get a bull bar that breaks. It's ideal if it happens on the same bar. This one does not. The next bar is okay as well, but this is a doji and doesn't even trigger below. So it's a bull doji and doesn't trigger. So if you're waiting for the high one, at this point, you're 4 bars in. So now we're at a situation where we have a microchannel against a larger microchannel down. So this 4-bar microchannel might need its own second leg up. So most traders who are trading with stops are probably not going to take this low one. Now, again, if you take the low one and you put a stop up here, in many cases, you're going to be okay because you're protected by the moving average. We're in a bear market. So it's okay to do that. But better after 4 bull bars like this is to wait for the first break and the resumption, and then wait for the resumption to fail. Once the resumption fails, now we're probably headed lower. So you can sell that for a swing or for a scalp or however you want to manage that trade. So when the high one opportunity turns into a microchannel and shows signs of strength, you have to switch to option 7, which is to wait for a second entry. That's the best option for stop entries in those situations. So here as well, strong bear spike, 3 bull bars up. It's a microchannel now. So it's a low one sell after this bear bar, but it's coming after 3 bull bars. It's coming after a 3-bar bull microchannel. So if you make the judgment based on context, based on the strength of the move, based on targets below, you could sell that below that low. But typically the best stop order entry here is to wait for the first breakout to fail and wait for a second entry sell. Now, if you did make the judgment call that this is going to work immediately, or you want to take the chance on it, you need to have a wide stop to allow for a second leg sideways to up. So if you do take that, your stop can't be above that. It's probably not the best idea. And here are some bull examples, right? So we have a microchannel here, but it's the 3rd leg and has a completed internal structure as well. But this is not only used for when we're in a strong microchannel. It's also anytime we're in a bull trend or in a bull move and you're expecting more up and you get a microchannel against, you want to wait for the resumption to fail and look for a second entry. So we've talked about these examples before. Bear spike, we got a second leg down already here, but now we're still expecting one more at least reasonably sized leg down from this. So you look for the first breakout to fail, take the second one, take the second reversal. So failure of a failure or failed resumptions, they're best in flags, so bear microchannels in bull trends and bull microchannels in bear trends, and also in trading ranges. So bear microchannels near the bottom of the trading range or bull microchannels near the top of the trading range. Now, in this example here, I was talking about this being the microchannel, this being the first break, and then the second break being here or here. So the second reversal down is here or here. I wasn't avoiding this bar. I use this chart to make a point that this can also be interpreted as a first entry on this breakout on bar 18, and then a second entry. So it's a breakout pullback sell, technically. The reason I have this chart here is because when situations occur like this, where the move up is strong in 3 bull bars, it's very common for the second entry that comes from a lower high. So we don't actually get a new high or a break above and then a second entry. It actually just comes from overlap. So it's like a bear breakout, an overlapping bar, and then a second entry sell. It can often just be leg 1, pullback leg 2 of the pullback of this move. So this is strong enough for a second leg. Is this bar all we get for the second leg? Often it's not. So when you get a second entry sell with a lot of overlap like this, where the breakout bar and the next bar overlaps it a lot, this can often just be the pullback of the pullback. So I have a lot of examples of that to show that it's actually quite common and something to be aware of and to be careful about. So here, for example, strong bull microchannel. We're waiting for a high one. This is an inside high one after the doji and the last bar. So it's not a great high one. So we wait for more information. So now we have a microchannel against the preceding trend. So we're looking to buy,
but we need to wait for a second entry. So we need to wait for a first break, resumption down, and then a second entry. Now, often what you get is you get a break and then no real resumption. So it's not even a strong break. It's not like closing above. It's not holding at the highs. It's just a tick above and then an inside bar high one. So when there's no clear resumption and you get like an inside bar high one with overlap, it's often just the second leg of the pullback. So this is the pullback, call it leg A. All of this is leg B. So this inside bar is just giving you an entry for the second leg of leg B. And then you get leg C. In this case, we got A, B, C, and it actually ended up being A, B, C. So it ended up being a much more complex pullback, which can happen. But it's just to be aware that if you're buying this as a high two, betting on a breakout pullback, you have to be aware that it's overlapping a lot and there isn't clear resumption. It's better if you get trend bars up, trend bars down, and then resumption. So you ideally want situations like this. So you got trend bar up, resumption down, bear bar, and then another bull bar. That's very clear. Whereas situations like this, where you get just a tick above and then an inside bar, similar to this, right? Like we have a bull trend coming down to the moving average. We get a breakout above with a tail, then an inside bar high one. That's often just going to lead to the second leg of the B leg. Now we're going to get C. So A, B, C. It's important not to think that just because we're getting the breakout pullback that this is A, B, C, and now we're just going to race up. So you have to be aware of that. If your stop's in the right place, it doesn't matter necessarily, but it's important to know what the expectation is of this kind of move. That these inside bars without clear resumption down and the failure of the resumption can often lead to these kinds of trading ranges. And so that's where we are here. When the move ends up as a microchannel against you and you're not getting clear trend bars and it's just forming overlap, you have to be aware that it could be evolving into a trading range. You have to wait for more information. So here as well. So leg one should get a second leg up, gets a microchannel against, gets a breakout, and then inside bar high one. This is still forming the pullback of the B leg. And then so we get A, B, C. So you have to be aware of that.
So contrast that with these situations I'm about to show. So 3-bar bull microchannel in a trending environment, strong breakout, closing above, trend bar down, trend bar up. So it's still an inside bar, and it may still even be best to use the proper swing stop here, but you can see that the moves are directional and they're strong. So we have strong breakout up. That increases the likelihood of a higher low breakout pullback buy. Same thing here, 4-bar microchannel down, strong breakout, closing above, bear bar, and then bull bar. It's still an inside bar. This ended up being an outside bar. So it's a micro double bottom and then a buy. But again, there's a direction here. There's a strong breakout. It increases the likelihood that a breakout pullback buy is going to work. Whereas in those other situations it's just a breakout with a doji. It's a breakout with a tail. So there's not much directionality there. And those are less likely to be strong moves that are going to get continuation for a breakout pullback buy or sell.
So that's the end of this chapter. I know it was super long. I know there were a lot of examples, but it really helped me to have a database of all these kinds of things. So I'm just sharing that with all of you as well. Again, this is my interpretation from everything I've learned over the years. So always open to discussion about certain topics and concepts if you have a different way of looking at it. I hope it was helpful. If you have any questions, leave them in the comments. And I'll talk to you guys soon.